Welcome to Yahoo Finance this Wednesday, September 18th. I'm Josh Lipton alongside Shauna Smith. We're moments away from the Fed's latest decision on interest rates. Markets right now, Shauna, you will not be surprised to learn basically fairly muted here. Wait and see mode. The Dow's down about 7 points. S&P 500 and the Nasdaq are both basically flat here. The big question we're waiting for, does the Fed cut by 25? Its normal move. Do they go a half point? We've spoken to a lot of different economists, strategists, columnists. They each make very good points. I'm basically most convinced by whatever the most recent argument I've heard. That's it. And the 50,
I'm with you.
The 50 camp says, you know, the Fed fund rate has been about 5% for a long time. It was there to fight inflation. Inflation's cool. We got to focus on the weak labor market. The 25 camp, and I find, comes on and says, you know what? Take a deep breath. Relax. The data is decent.
Yeah, and I think it's hard to remember the last time that the market has been so split, just in terms of what the Fed is going to do, or maybe just flipping so quickly between the 25 versus 50 basis point. Even just looking at CME Fed Fund futures over the last several weeks, and that really illustrates just how split Wall Street still remains. And we're just less than a minute out from this decision. And I think the big question here, top of mind for investors, is it ultimately what this means for the equity markets moves down the road. If we do get a 25 basis point, many of that consensus out there is that that could be interpreted as a disappointment here for the markets, given the fact that the market is pricing in closer to a 50 basis point cut. If we do get a 50 basis point cut, maybe initially we could see a bit of excitement, but then of course, whether or not that knee-jerk reaction is going to then prove to be a bit of a backlash here down the road, if we could see a reversal, because ultimately what that would signal about maybe some underlying weakness in the economy. But I agree with you. The last person I talk to, whatever they tell me, whatever argument they lay out, I'm just like, you know what? That actually makes a heck of a lot of sense, and I agree with you. All right, well, the Fed's decision is out. Let's get to Jennifer Schomburger. Hey, Jen.
50 basis point rate cut, the Federal Reserve slashing its benchmark interest rate by a half a percentage point to a new range of 4.75% to 5%, marking the first rate cut in more than 4 years. Now, Fed officials see 2 more 25 basis point rate cuts this year, followed by 4 more cuts next year and 2 more cuts in 2026. Breaking down what officials saw, 9 officials saw 4 cuts this year, so that includes the 50 basis point rate cut today. 7 saw 3 cuts. 2 officials saw 2 cuts this year, and 1 saw 5 cuts. Now, officials say in their statement they are gaining confidence that inflation is moving sustainably back down to 2%, saying, removing the word some, and now saying instead that inflation has made, quote, further progress towards the Fed's 2% goal. The statement also reading that, quote, the committee has gained greater confidence inflation is moving sustainably towards 2% and judges that the risks to achieving its employment and inflation goals are roughly in balance. Now, future rate cuts will depend on the evolving economic outlook, as well as the incoming data and the balance of risks. The outlook for interest rate projections come as Fed officials now see the unemployment rate rising to 4.4% this year and holding at that level over the next couple of years. That's up from 4% previously forecast. At the same time, economic growth is seen at 2% this year instead of 2.1% previously forecast, and officials expect the economy to coast at that 2% level over the next couple of years. As for inflation, they moved down their inflation outlook. They now see inflation ending the year at 2.6%. That's down from 2.8% previously, and then moving down to 2.2% over the next year. Now, there was some division on today's decision. It was a split vote. It was not unanimous. Fed Governor Michelle Bowman dissented, saying that she would have preferred to have cut rates by 25 basis points instead of 50. This marks the first dissent in 2 years. Back to you.
Jennifer, I'm just curious to get your take on this decision. Were you surprised by it, Jennifer? You know, we had any number of economists come on this show recently say, listen, banging the table for 25, saying data has been decent, the economy's, you know, resilient. They thought, frankly, you know, look at retail sales this week, surprised to the upside. They said they really thought the Fed was going to do a 25, the normal cut, and if they had to, ramp from there. But interested to get your take.
Yeah, absolutely, Josh. I was a bit surprised. I know we saw some media reports floated Friday, Monday, sort of setting the stage for the potential 450. I was surprised, though, because to your point, yes, we've been hearing from a lot of strategists, but other Fed officials coming into the blackout period did not seem to point towards a larger jumbo cut today. They seem to think that the data would point towards more of a 25 basis point rate cut, and they would take more of a gradual, measured approach. That is what I heard from Fed officials I personally talked to. So now the question becomes, is the Fed behind the curve? Is this a proactive move? We'll hear from Fed Chair Jay Powell here in a couple minutes in the press conference, but it's curious to know whether this was a move, a sort of preemptive move to stave off further weakening in the job market, something certainly that Fed Chair Powell had alluded to back in Jackson Hole the last time we heard from him, and whether this is to preserve the soft landing scenario.
All right, Jennifer, thanks so much for breaking this down and bringing us this breaking news here. Let's take a quick look at the market's reaction here as we do see some reaction to a 50 basis point cut. You are seeing the Nasdaq up just about 0.8%, also gains across the S&P and the Dow. When it comes to the dot plot projections here, Josh, that was a key interest point here for investors. And when you take a look at what the Fed is expecting, policymakers now penciling in 100 basis point cuts of easing by year end, which would mean then two additional cuts, you would think, of 25 basis points. So that not necessarily really moving the needle versus what the expectations were going.
The dot plot is also so interesting because it's a projection. It's not like it's poured in concrete, right? I mean, the last time we had dot projections was in June. They had one cut. You know, they were worried about inflation there. So you keep that in mind as an investor. It is interesting. Listen, we had some noted economists and strategists who did make this case, and they frankly thought, you know, as I said, the federal funds rate been about 5% for a long time. It was time to shift the target, shift the focus.
All right, well, let's kick it over to Jared Blicker, who's standing by with a closer look at the market's reaction to this decision. Jared.
Thank you. Let's pull up the Wi-Fi Interactive here. We have a bullish reaction. I'm not going to call it muted. I'm not going to call it outsized. It's just a reaction. But to be fair, everybody's going to be looking toward Jay Powell in a few minutes, and they want to look into his eyes and see, is he scared of recession? That's really the question for investors. Is this 50 basis points preemptive, as Jennifer was asking? Is it preemptive to prevent something that maybe the Fed sees in the data? So data-dependent Fed is going to have, it's going to face a lot of pointed questions this afternoon. Now, here's the Nasdaq. Nasdaq is outperformance, up 75 basis points. Here's the Russell 2000. It is barely even right now. And let's check out, we've got some movement in the bond market. Two-year T-note futures. Now, these are the futures, not the rate. Those have climbed back to the break even. That means rates were elevated. The 10-year was about 4 basis points up. It has now given that back as the Fed is forecasting, has cut rates more than expected. And we can also see what's going on in gold futures. Gold futures have now spiked up. That may be another record high. Here's a 4-day look, not quite a record high, but getting back towards these record highs that we had on Monday. Also take a look at WTI crude. Doesn't look like we're having much of a reaction, and that is not a surprise. WTI doesn't usually move on these reports. Sometimes they do. And finally, we just want to check out Bitcoin. Bitcoin is also participating in the risk on movement here. You can see it's up just slightly on the day. And I'll leave you with the sector action. We are seeing consumer discretionary in the front position and only utilities in the red.
Thank you, Jared. For more on the Fed's decision to cut interest rates by 50 basis points, want to welcome in now Threadneedle Ventures founder Ann Berry, as well as Greg Dacco, EY chief economist. Welcome to you both. Greg, I'll start with you. All right, so the Fed just go with the supersized route, half a point. Was that your expectation, Greg?
It was not my expectation. I was expecting gradualism would win the day, but the Fed decided to go big or go home. I think that shows that Fed Chair Powell, who was the leader in terms of this openness to larger rate cut, managed to convince his colleagues, who up until very recently were talking about a methodical approach to easing monetary policy. I think that is the right decision, though, even though that's not what I was expecting. I think going larger with a 50 basis point rate cut allows the Fed to catch up to where it should have been in terms of placing monetary policy in a much better strategic position, approaching the slowdown that we're starting to see in the labor market.
What do you think, Ed? Do you agree? Does 50 make sense?
50, whether it is this time around or 225s, in my mind, it doesn't make any difference. I think it's about the 100 basis point reduction over the longer term. But this does raise a question for me. Historically, 50 basis points came before a recession or fears of a recession. So this voiceover, is this the time where that is no longer the indicator it used to be? Or do we hear from Fed Jay Powell that things are weaker than we thought?
What, as Greg is the resident economist here, when you look at the economy right now, do you see cooling or do you see something more ominous on the horizon?
I see something of a softening in terms of economic momentum, not a retrenchment. The key reason, and we've talked about this in the past, is because the labor market is not showing any signs of a retrenchment. You're still seeing employers valuing the value of talent. You're not seeing any broad-based layoffs. That's still supportive of steady growth in terms of employment, which in turn is supporting income and in turn consumer spending. But when we think about the economy, the Fed has to be a bit forward-looking. So what it's doing right now is catching up to today's economic conditions, because I think it was behind the curve, focusing too much on old data and the fear of inflation reigniting, and now adjusting its policy setting to be able to more strategically respond to any further slowdown in economic activity. I'm a little bit surprised, to be honest, that it's only showing, that dot plot is only showing 100 basis points of rate cuts since they went with 50 at this meeting, because that means only 2 25 basis point rate cuts. How is the Fed going to communicate this intent to go back to 50 to 25 basis point rate cut increments at the November and December meeting?
And do you think, when we talk about the rotation, that certainly has started to take place, and we talked about the inflows, especially over the last couple of weeks, into more of the defensive plays, when you talk about real estate, consumer staples, utilities, a cut like this with 50 basis points, we're seeing the Russell 2000 spike just a little bit here. Is that going to then add a little bit more juice to that rotation that we've already seen take place?
I think it really depends on what the voiceover is. Is this 50 basis points because Jay Powell made the judgment that the consumer needed the help? Or was it 50 basis points because the assumption was the consumer's really resilient, actually the economy is doing a little bit better than we thought, and inflation is under control, so let's give it the juice while we can. Until we get clarity on which way the argument falls, I think it's very hard to know how this rotation is going to play out.
Do you think, are there risks, Greg, to going 50 that you can see? You've laid out kind of the positive case. Would there be risks that you think investors need to consider?
I don't believe in the risk that the Fed is signaling anything that we don't know about. If anything, the Fed has been extremely...
That was one question, is whether investors would say they would do 50 and people would say, yikes, Jay Powell must see something.
They're not panicking. I think Fed Chair Powell is very much aware of the situation in terms of the economy cooling, not falling off a cliff. And this type of rate cut is really a catch-up effect of realizing that both sides of the mandate are now as important. That was in the statement, equal weight to both sides of the mandate, and that we have to pay a little bit more attention to the slowdown in the labor market. So I don't think this is a signal of any reason to panic, but I do think it's very important that the Fed and Fed Chair Powell during the press conference focus on a forward-looking framework. Data dependency is done. We should get rid of that and now focus on a forward-looking perspective and have Fed Chair Powell communicate where they believe neutral monetary policy is, not in 4 years, which is in the dot plot, but today, and how do we get there?
Greg, what is your assessment of the labor market? Because when you take a look at these projections, and you're now seeing unemployment at 4.4% compared to just 4.2% today. Not significantly more weakness, but is this something that investors, that economists are a bit worried about?
I do think it's something to be concerned about. I mean, we have rarely seen, and you mentioned that, we have rarely seen an environment where the unemployment rate just rises gently and then stops and then comes back down. Generally speaking, there is momentum in a rise in the unemployment rate. That's why we have the SOM rule. That's a good indicator of historical downside risks to the economy. And I think we have to keep in mind that while the value of talent has increased and while employers are being very cautious with who they hire, how they hire, and how much they lay off, there is still the potential for a more pronounced slowdown in economic activity and a more rapid turn up in the unemployment rate. And I think one key highlight in the latest projections is the fact that the unemployment rate was revised up by 0.4. That's a massive upside risk in terms of the forecast.
And there was one school of thought out there by some market watchers which said Jay Powell was going to cut 50 because the financial markets expected 50. And Jay Powell didn't want to wake up tomorrow morning, have a cup of coffee, open the paper and say, and the headline is, Jay cut by 25, disappointed, stocks plunge. What do you make of that?
I think Jay Powell's been pretty immune to that sort of pressure to play to the market's expectations.
It's water off a rock. He doesn't feel it.
And I think that's his superpower. I think that's been his strength. And I think there's, there are two forms of pressure. There's the pressure of Wall Street expectations, the pressure of accusations around jumbo cuts before the election, right? That's another pressure we haven't talked about. I think what he's done there...
Do you expect political blowback on that?
I do think there's going to be some discourse around it, for sure. Again, let's see what he says in the presser, because he may be able to take the edge off it. But I see it a little differently. By doing 50 now, I think he's bought a little bit of time. right? Imagine if he'd done 25, the data came in saying things aren't looking so great, and then he had to do 50 later. He'd have the same criticism as he had, right, on the way up here. So I think the fact he's one and done, I think he's sort of one and done for a minute right now, I think helps him.
And he also mentioned that at the Jackson Hole meeting a few weeks ago. Let's not forget that. His speech was very open in terms of the trajectory of monetary policy, very different than his colleagues who were talking about, we're going to go methodically, we're going to go gradually. He did not mention gradualism.
Do you give Greg a high grade to their communication strategy? Because some economists, not such big fans.
No, I don't think the communication strategy has been good at all. If anything, I think up until this weekend, where everybody was pricing in a 25 basis point rate cut, then you had a couple of news articles that started floating some speculation as to a 50 basis point rate cut. I think that is a sign of poor communication. I think there needs to be much better communication of, as I said earlier, the monetary policy framework, which needs to be forward-looking and not data point dependent, which it still is. And two, communicate the intent of where we're going in terms of monetary policy from a policy neutralization perspective and how rapidly we'll get there.
All right, Greg and Ann, great to talk to you both, have you both here to weigh in on this historic cut that we have been waiting for. Again, a 50 basis point cut here from the Fed. The market's taking it in stride, and we're seeing all three of the major averages move to the upside. Guys, we'll be hearing more from both of you after Jay Powell's press conference here in just about 17 minutes. Well, for more on the Fed's decision, we want to bring in Vishal Kanduja. He is at Morgan Stanley's asset management co-head of broad markets fixed income. It's great to have you here. So when you take a look at the bond market's reaction, front end of the curve, you're taking a look at the 2-year had dropped. It was off just about 10 basis points after we initially got that decision. I'm curious just your first reaction to 50 basis point cut.
Definitely a little surprising, as the other commentators were mentioning on the show before as well. We were in the dovish 25 camp here. So surprise on the left-hand side, meaning in the front end, 50 basis points, but then not a surprise on the back end, 100 basis points next year, 100 for the year after that, a little shallower, bringing it down in terms of rates, and the terminal rate slightly higher by an eighth, if you will. And I think the very clear, like one of the things that was changed in the S&P was the unemployment was higher by about 0.4. So clearly remains the focus remains still on the unemployment side versus the second mandate, which is inflation. So slightly surprising on the front end, but then not so surprising on the back end. So steepening reaction from the bond curve is very, very legitimate at this point.
Vishal, now all eyes turn to Jay Powell at this presser. So let's say, Vishal, I'm going to make you a reporter. You cover the Fed. You're in that presser, Vishal. What would you ask Jay Powell? What's top of mind?
Playing the 50 basis points, I think that is the main thing right now. Is it a make-up 50 basis points? Because if you think about it, just rewind the clock back to the blackout period started on Monday. At that point, going into it, we were very clear, and the market was very clear with the dovish 25 basis points being the outcome here. So that change in thought process from that until today, I think that 50 basis points, if you will, market would require a little bit of that explanation, and then the explanation of the back end as well of why shallower is the confidence more in the soft landing sort of camp, or is it that a little bit of that catch up or make up that we are slightly behind the curve here to start off. So definitely that is top of mind for me at the moment.
Vishal, does this make you think twice about the soft landing camp, but whether or not you're confident that we are going to see a soft landing?
You know, from the data that we are tracking, and then the Fed also sees the same thing, I think definitely cooling or rebalancing. This is very clearly in our minds a recalibration cut cycle rather than recessionary cut cycle that they're getting into. And the timing is right. Maybe they were off by a meeting or two, but they have a lot in their toolkit. I think we are not even talking about balance sheet at this point. We have 550 basis points, or maybe just 500 at this point to go, but still a lot in the toolkit. So given that, and then you marry it with strong balance sheets on the consumer and corporate side that we are coming here at this point in the cycle with. So those two together, still our confidence is very high for a soft landing.
Even, Vishal, there was some kind of speculation out there And this is from folks who thought Jay Powell wouldn't do 50 because they said if he does 50, the initial reaction may be positive and, muted positive reaction right now. Major averages up in the green. But then investors might think twice. They might think, well, why is the Fed doing 50? Why is the Fed doing a supersized cut? Maybe they see something in the data that we don't. What do you make of that argument?
No, definitely that we had the same discussions even this early as late as this early morning today as well, in terms of the pros and cons for 25 and 50. I think the back end dots have really helped that argument or present that argument very cleanly. They did not tinker too much with the statement. I know there are still a lot of red lines, but not drastic changes from the statement or surprising statements, changes in the statement. And then I think they re-brought that point back up into the focus that unemployment still remains their primary focus. So, trying to give us the dovishness there, but not trying to show us a lot more nervousness with the shallower path of decline in rates over the next 2 years. So I think it marries or it levels off some of that fear that we also had that a 50 basis points will bring out. What does the Fed know that we don't know? But I'm sure probably the first or the second question in the presser will be about that. In terms of explaining the background on that 50 bits.
So Vishal, given all this and given where the Fed stands right now, obviously we're going to hear a bit more from Powell in just a few minutes. But what is, I guess, your takeaway for bond market investors right now? What are you favoring as a result of this, just given the fact that there still is so much uncertainty surrounding the stability of the economy?
Stick with stronger balance sheets as bond market participants. I think that is the first statement. I think there is a dual mandate that fixed income has, apart from the dual mandate at the Fed. It's income and negative correlation to risky assets. So that is, bond market has delivered on that over the last 2 years. We're outperforming cash. I think the next 2 years with this kind of Fed and this kind of outlook on the economy and the rate cycle, I think fixed income will outperform cash. So we are still pretty bullish on duration. Steepeners is how we are positioned in the portfolios. We are pro-risk. We are liking securitized credit the best at this point. Some parts of the corporate balance sheets are overweighted as well. So there's quite a bit good to offer in fixed income, both from an income as well as a strong balance sheet perspective.
Vishal, thank you so much for being on the show today. Appreciate your time, sir.
Thank you.
And coming up, we'll get you set for Fed Chair Jerome Powell's press conference following that half-point cut. Stick around. More Yahoo Finance still to come. The Federal Reserve cutting rates by 50 basis points. We're now bringing in Thomas Honig, former Kansas City Fed president and CEO, and Mercatus Center Distinguished Senior Fellow. Thomas, it is good to see you. So the Fed does deliver a supersized cut, Thomas. Was that your expectation?
Well, no, it was not. I thought they would be more cautious. And I'm somewhat disappointed, excuse me, I'm somewhat disappointed by it. But I think based on this, they've taken a little bit of a victory lap. They're thinking inflation's pretty much down. I look at CPI inflation, it's still 2.5% year over year, and core 3.2. I'm not quite sure they should be taking that victory lap, but it's their choice, and I think it will certainly stimulate the economy. And I suspect it may even stimulate some future inflation.
So then, Thomas, given those risks that you see because of this 50 basis point cut, that is there a higher risk? I think you would say yes, maybe. Then we could see a reversal down the road, and that they would eventually be forced to hike, given the fact that this could actually be a bit stimulus here for the economy.
Well, I think that's a possibility, number one, because they've done 50 basis points. That makes the next 50 basis points, this 50 basis points that the market was expecting by at least year end, a much higher probability. There's going to be a fair amount of stimulus around that, I suspect. The stock market is close to historic highs. Labor market, while everyone talks about the unemployment rate increasing, it's 4.2% in an historical context. That's still very low. And initial unemployment claims still remain low. So there's a lot of remaining momentum in the economy, although the consumer is slowing, and everyone is aware of that. But I think we'll see how that plays out. It may be temporary as wages continue to hopefully catch up with the price increases that they've had to endure, and we'll see how the economy moves from here. But I think further cuts are now being weighed in much more likely, and therefore some more stimulus coming towards the economy, and perhaps a little slower reduction in the inflation rate, or even a stalling out.
And Thomas, now we await Jay Powell's presser. What do you want to hear from the Fed chief?
Well, I think he'll be asked probably as many times that there are media in there. What is your next move? What can we expect? What would cause you to do another 50 basis point? Are you going to go back to 25 basis point? There'll be a lot of questions around that as he moves through that press conference, I would suspect.
Thomas, do you think this decision could be viewed as politically driven? Because that was a big question, a big concern going into this. And now that we do have 50 basis point cut happening less than 2 months ahead of the election, is that a risk? Should that be viewed as a risk?
Well, I think it's a risk. I don't know that was their motive. It's hard to know what was going on inside that meeting. But I think some people will interpret it very much as a political move. But that'll play out over time. I don't know the individuals thinking as they went into this 50 basis point. Some of them I know, even ahead of this, were very convinced 50 basis point was the right number. Not all were, but we'll see. We'll just see how it plays out in the political frame.
Thomas, you were the former Kansas City Fed president. I'm interested, how do you imagine it played out in that room as they were making this historic decision here?
Well, I think yesterday was spent talking about the economy a great deal. What are you seeing across the regions? Are we seeing a slowdown? Are you seeing inflation coming down more quickly than perhaps we initially thought? That debate went on back and forth yesterday, and then today was about policy and should we do a 50 point or 25? There had to be a pretty strong consensus around that, but particularly the chairman who leads that discussion must have been convinced before he went into that meeting the 50 basis point was the right number. And so he spent a fair amount of time after listening to everyone, talking to them before the meeting, and then laying out the fact that this would be 50 basis points and perhaps talking about how they would proceed from here. And that conversation would be pretty hard to anticipate. We may get a better picture of that during the press conference that's coming up, how they're thinking forward and how much he's willing to disclose.
All right, Thomas. Thomas, great to get your insight on a day like today. Thomas Honig, former Kansas City Fed president and CEO. Thanks so much for joining us here today.
Glad to be with you.
Part of the Fed decision, including the release of the economic projections and its new dot plot. Yahoo Finance's Madison Mills joins us now with a closer look at those projections. Hey, Maddie.
Hey, Shauna. So a day for the doves and for dissent. I want to run through this dot plot behind me. I'm going to break down what all these dots on your screen mean. So right here, you can see about 9 individual dots. And each of these dots, by the way, represents a voting member of the Federal Reserve, all 19, from Fed Chair Jay Powell to every single other member, including the one member who voted against 50 basis points of cuts, which we will get to. But you can see here, 9 members saw 4 cuts this year, including today's cuts. We also saw 7 members seeing 3 cuts this year. 2 saw 2 cuts. And then you've got 1 down here seeing a total of 5 cuts for the rest of the year. Now, officials are expecting another 50 basis points of cuts by year end. That would get us down to this dot plot area for the total year of 2024 over to 2025. That would bring the benchmark rate to 3.4% by 2025. It's expected to fall another 50 basis points by the time we get to 2026. That would put the median forecast for the Fed rate in 2026, the neutral rate, to 2.9%. That is up 1/10 from the previous forecast that we got from the Summary of Economic Projections back in June. And by the way, guys, I do want to mention they don't just give us the dot plot. They also indicate for us where they see things like unemployment going. They see unemployment hitting 4.4% this year, falling down to 4.3% by 2026. That could give us a little bit more of a clue as to why they went with 50 basis points today, because that is a pretty significant uptick in terms of unemployment. I also want to mention that they did not make any changes today to quantitative tightening. So that's another tool that they have in their toolbox beyond interest rate moves. They did not move to change anything on that end. So why are we talking about all of these dots here, right? This gives us an indication of the Fed's path forward. And I want to zero in on this 2025 benchmark rate. You can see that we've obviously moved down from this set of dots to these over here. And this gives us the opportunity to look at the median rate for 2025 coming in at 3.4%. But you can see all of these dots kind of all over the place, right? That indicates that there was dissent on the Fed as they think about the projections for where rates are heading in 2025. The range was between 2.9% to 4.1%, 2.9 to 4.1. That's a pretty big range for the Federal Reserve. And this is perhaps the first time, at least in recent memory, that we have seen dissent playing out publicly with the Federal Reserve. This is certainly being viewed by the market as a fairly dovish SEP, but the question will it be even more dovish once we hear from Jay Powell in a few minutes.
All right, Maddie, thanks so much for breaking that down for us. Certainly that is going to be the focus, how dovish Powell is going to be at this press conference that's expected to, and it is happening right now. We have Fed Chair Jay Powell approaching the podium. Let's listen in.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state. Inflation has eased substantially from a peak of 7% to an estimated 2.2% as of August. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by 0.5 percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.2% in the first half of the year, and available data point to a roughly similar pace of growth this quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment fell back in the second quarter after rising strongly in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of 2% over the next few years. In the labor market, conditions have continued to cool. Payroll job gains averaged 116,000 per month over the past 3 months, a notable step down from the pace seen earlier in the year. The unemployment rate has moved up, but remains low at 4.2%. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggest that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year, 0.4 higher than projected in June. Inflation has eased notably over the past 2 years, but remains above our longer-run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.2% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 2.7%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.3% this year and 2.1% next year, somewhat lower than projected in June. Thereafter, the median projection is 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. Our primary focus had been on bringing down inflation, and appropriately so. We are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our restrictive monetary policy has helped restore the balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remain well anchored. Our patient approach over the past year has paid dividends. Inflation is now much closer to our objective, and we have gained greater confidence that inflation is moving sustainably toward 2%. As inflation has declined and the labor market has cooled, the upside risks to inflation have diminished and the downside risks to employment have increased. We now see the risks to achieving our employment and inflation goals as roughly in balance, and we are attentive to the risks to both sides of our dual mandate. In light of the progress on inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate by a 0.5 percentage point to 4.75% to 5%. This recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we begin the process of moving toward a more neutral stance. We are not on any preset course. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. These median projections are lower than in June, consistent with the projections for lower inflation and higher unemployment, as well as the changed balance of risks. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation back down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve Leisman, CNBC. Thank you, Mr. Chairman, for taking our questions. In July, you said you weren't necessarily thinking about a 50. You didn't want to be specific, but you said you were thinking about a 50. The inflation data last week came out a little firmer than expected. Retail was strong, third quarter GDP running 3%. So what changed and made the committee go 50, and how do you respond to the concerns that perhaps it shows the Fed is more concerned about the labor market? And I guess, should we expect more 50s in the months ahead? And based on what should we make that call? Thank you.
So, okay, a lot of questions in there. Let me jump in. Since the last meeting, we have had a lot of data come in. We've had the two employment reports, July and August. We've also had two inflation reports, including one that came in during blackout. We had the QCEW report, which suggests that suggests that the payroll report numbers that we're getting may be artificially high and will be revised down. You know that. We've also seen anecdotal data like the Beige Book. And so we took all of those and we went into blackout and we thought about what to do, and we concluded that this was the right thing for the economy, for the people that we serve, and that's how we made our decision. So that's one question. What was the second and third?
How do we make the sorry, thank you, sir. How do we figure out in the months ahead, is there another 25 or 50 coming in? Based on what shall we make that call? Thank you.
Sure. So a couple things. A good place to start is the SEP, but let me start with what I said, which was that we're going to be making decisions meeting by meeting based on the incoming data, the evolving outlook, the balance of risks. If you look at the SEP, you'll see that it's a process of recalibrating our policy stance away from where we had it a year ago when inflation was high and unemployment low, to a place that's more appropriate given where we are now and where we expect to be. And that process will take place over time. There's nothing in the SEP that suggests the committee is in a rush to get this done. This process evolves over time. Of course, that's a projection. That's a baseline projection. We know, as I mentioned in my remarks, that the actual things that we do will depend on the way the economy evolves. We can go quicker if that's appropriate. We can go slower if that's appropriate. We can pause if that's appropriate. But that's what we were contemplating. Again, I would point you to the SEP as just an assessment of where of what the committee is thinking today, what the individual members, rather, of the committee are thinking today, assuming that their particular forecasts are realized.
Go ahead, Chris.
Hi, Chris Rugaber at Associated Press. Thank you. The projections show that the Fed officials expect the Fed funds rate to still be above their estimate of long-run neutral by the end of next year. So does that suggest you see rates as restrictive for that entire period? Does that threaten the weakening of the job market that you said you'd like to avoid? Or does it suggest that maybe people see the short-run neutral as a little bit higher? Thank you.
I think the way I would really characterize it is this. I think people write down their estimate, individuals do. I think every single person on the committee, if you ask them what's your level of certainty around that, and they would say there's a wide range where that could fall. So I think we don't know. There are model-based approaches and empirically based approaches that estimate what the neutral rate will be at any given time. But realistically, we know it by its works. So that leaves us in a place where we expect, in the base case, to be continuing to remove restriction and we'll be looking at the way the economy reacts to that, and that'll be guiding us in our thinking about the question that we're asking at every meeting, which is our policy stance the appropriate one? We know, if you go back, we know that the policy stance we adopted in July of 2023 came at a time when unemployment was 3.5% and inflation was 4.2%. Today, unemployment is up to 4.2%, and inflation's down to a few tenths above 2. So we know that it is time to recalibrate our policy to something that is more appropriate given the progress on inflation and on employment, moving to a more sustainable level, so that the balance of risks are now even. And this is the beginning of that process. I mentioned the direction of which is toward a sense of neutral. And we'll move as fast or as slow as we think is appropriate in real time. But what you have is our individual accumulation of individual estimates of what that will be in the base case.
Howard.
Howard Schneider with Reuters. How close was this in terms of the decision? You do have the first dissent by a governor since 2005, I think. Was the weight clearly in favor of a 50, or was this a very close decision?
I think we had a good discussion. If you go back, I talked about this at Jackson Hole, but I didn't address the question of the size of the cut and left it open. And I think we left it open going into blackout. And so there was a lot of discussion back and forth, good diversity of division, excellent discussion today. I think there was also broad support for the decision that the committee voted on. So I would add, though, look at the SEP. All 19 of the participants wrote down multiple cuts this year, all 19. That's a big change from June, right? 7 of them wrote down 3 or more, and 17 of the 19 wrote down 3 or more cuts, and 10 of the 19 wrote down 4 or more cuts. So, there is a dissent, and there's a range of views, but there's actually a lot of common ground as well.
Follow up to that, now that this is in the books, can you give us some guidance as sort of follow up to Steve on the pacing here? Would you expect this to be running every other meeting once we get into next year?
Yeah, we're going to take it meeting by meeting. As I mentioned, there's no sense that the committee feels it's in a rush to do this. We made a good, strong start to this, and that's really, frankly, a sign of our confidence. Confidence that inflation is coming down toward 2% on a sustainable basis. That gives us the ability. We can, make a good, strong start, but. And I'm very pleased that we did. To me, the logic of this, both from an economic standpoint and also from a risk management standpoint, was clear. But I think we're going to go carefully, meeting by meeting, and make our decisions as we go.
Gina.
Hi, Chair Powell. Gina Smilik of the New York Times. Thanks for taking our questions. You and your colleagues in your economic projections today see the unemployment rate climbing to 4.4% and staying there. Obviously, historically, when the unemployment rate climbs that much over a relatively short period of time, it doesn't typically just stop. It continues increasing. And so I wonder if you can walk us through why you see the labor market stabilizing, sort of what's the mechanism there, and what do you see as the risks?
So, again, the labor market is actually in solid condition. And our intention with our policy move today is to keep it there. You can say that about the whole economy. The U.S. economy is in good shape. It's growing at a solid pace. Inflation is coming down. The labor market is in a strong pace. We want to keep it there. That's what we're doing.
Sorry, Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, does today's action constitute a catch-up in action given recent substantial revisions to the employment data? Or is this larger than typical rate cut a function of the elevated nominal level of the policy rate such that an accelerated cadence could be expected to continue?
Okay. Multiple questions in there. But so I would say we don't think we're behind. We do not think we think this is timely. But I think you can take this as a sign of our commitment not to get behind. So it's a strong move. Sorry, your other question was?
Well, is this about what happened in the employment data between this meeting and the last meeting, or is this about the level of the funds rate the high nominal level of the funds rate relative to what might be expected if you're trying to maintain equilibrium?
So I think it's about, we come into this with a policy position that was put in place, as you know, I mentioned in July of 2023, which was a time of high inflation and very low unemployment. We've been very patient about reducing the policy rate. We've waited. Other central banks around the world have cut, many of them several times. We've waited, and I think that patience has really paid dividends in the form of our confidence that inflation is moving sustainably down to 2%. So I think that is what enables us to take this strong move today. I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. So in the base case, what you see is, look at the SEP. You see cuts moving along. The sense of this is we're recalibrating policy down over time to a more neutral level, and we're moving at the pace that we think is appropriate given developments in the economy in the base case. The economy can develop in a way that would cause us to go faster or slower, but that's what the base case says.
And if I could follow up on the balance sheet. In 2019, when you did the mid-cycle adjustment, you ceased the balance sheet runoff. With a larger cut today, should there be any signal inferred about how the committee would approach end state on the balance sheet policy?
So in the current situation, reserves have really been stable. They haven't come down. So reserves are still abundant and expected to remain so for some time. As you know, the shrinkage in our balance sheet has really come out of the overnight RRP. So I think what that tells you is we're not thinking about stopping runoff because of this at all. We know that these two things can happen side by side. In a sense, they're both a form of normalization. And so for a time, you can have the balance sheet shrinking, but also be cutting rates.
Colby. Thank you. Colby Smith with the Financial Times. Just following up on Gina's question on rising unemployment, is it your view that this is just a function of a normalizing labor market amid improved supply, or is there anything to suggest that something more concerning perhaps is taking place here, given that other metrics of labor demand have softened too? And I guess in direct follow-up to Gina is, why should we not expect a further deterioration in labor market conditions if policy is still restrictive?
So I think what we're seeing is clearly labor market conditions have cooled off by any measure, as I talked about in Jackson Hole. And but they're still at a level. The level of those conditions is actually pretty close to what I would call maximum employment. So you're close to mandate, maybe at mandate on that. So what's driving it? Clearly, payroll job creation has moved down over the last few months, and this bears watching. By many other measures, the labor market has returned to or below 2019 levels, which was a very good, strong labor market, but this is more sort of 2018, 17. So the labor market bears close watching, and we'll be giving it that. But ultimately, we believe, with an appropriate recalibration of our policy, that we can continue to see the economy growing, and that will support the labor market. In the meantime, if you look at the growth in economic activity data, the retail sales data that we just got, second quarter GDP, all of this indicates an economy that is still growing at a solid pace. So that should also support the labor market over time. So, but again, it bears watching, and we're watching.
And just on the point about starting to see rising layoffs, if that were to happen, wouldn't the committee already be too late in terms of avoiding a recession?
So our plan, of course, has been to begin to recalibrate. And as you know, we're not seeing rising claims. We're not seeing rising layoffs. We're not seeing that, and we're not hearing that from companies that that's something that's getting ready to happen. So we're not waiting for that, because there is thinking that the time to support the labor market is when it's strong, and not when you begin to see the layoffs. There's some lore on that. So that's the situation we're in. We have, in fact, begun the cutting cycle now, and we'll be watching, and that'll be one of the factors that we consider. Of course, we're going to look at the totality of the data as we make these decisions meeting by meeting.
Michael.
Michael McKee with Bloomberg TV and Radio. To follow up on that, what would constitute for you and the committee a deterioration in the labor market? You're pricing in basically by the end of next year 200 basis points of cuts just to maintain a higher unemployment rate. Would you be moving to a more preemptive monetary policy style rather than, as you did with inflation, waiting until the data gave you a signal?
No, we're going to be watching all of the data, right? So if, as I mentioned in my remarks, if the labor market were to slow unexpectedly, then we have the ability to react to that by cutting faster. We're also going to be looking at our other mandate, though. We have greater confidence now that inflation is moving down to 2%, but at the same time, our plan is that we will be at 2%, over time. So, and policy we think is still restrictive, so that should still be happening.
I'm just curious as to how sensitive you'll be to the labor market, since you forecast we are going to see higher unemployment and it is going to take a significant amount of monetary easing to just maintain it.
So, what I would say is we don't think we need to see further loosening in labor market conditions to get inflation down to 2%. But we have a dual mandate, and I think you can take this whole action as take a step back. What have we been trying to achieve? We're trying to achieve a situation where we restore price stability without the kind of painful increase in unemployment that has come sometimes with disinflation. That's what we're trying to do. And I think you can take today's action as a sign of our strong commitment to achieve that goal.
Rachel. Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. You're describing this view that you don't think you're behind when it comes to the job market. Can you walk us through the specific data points that you found to be most helpful in the discussions at this meeting? You've mentioned a couple, but would you be able to walk us through what that dashboard told you as far as what you know about the job market now?
Sure. So we'll start with unemployment, which is the single most important one probably. You're at 4.2%. That's, I know that's higher than we were used to seeing numbers in the mid and even below mid threes last year. But if you look back over the sweep of the years, that's a very healthy unemployment rate. And anything in the low fours is a good labor market. So that's one thing. Participation is at high levels. It's, we're right adjusted for demographics, for aging. Participation's at pretty high levels. That's a good thing. Wages are still a bit above what would be, their wage increases rather, are still just a bit above where they would be over the very longer term to be consistent with 2% inflation, but they're very much coming down to what that sustainable level is, so we feel good about that. Vacancies over, per unemployed is back to what is still a very strong level. It's not as high as it was. That number reached 2 to 1, 2 vacancies for every unemployed person, as measured. It's now below around 1, but that's still a very good number, I would say. Quits have come back down to normal levels. I mean, that could go on and on. There are many, many employment indicators. What do they say? They say this is still a solid labor market. The question isn't the level. The question is that there has been change, particularly over the last few months. And so what we say is, as the risks, the upside risks to inflation have really come down, the downside risks to employment have increased. And because we have been patient and held our fire on cutting while inflation has come down, I think we're now in a very good position to manage the risks to both of our goals.
And what do you expect to learn between now and November that will help inform the scale of the cut at the next meeting?
More data, the usual. Don't look for anything else. We'll see another labor report. We'll see another jobs report. I think we get a second jobs report on the day of the meeting, I think. On the Friday before the meeting. And inflation data. We'll get all this data. We'll be watching. It's always a question of look at the incoming data and ask what are the implications of that data for the evolving outlook and the balance of risks, and then go through our process and think what's the right thing to do. Is policy where we want it to be to foster the achievement of our goals over time? So that's what it is, and that's what we'll be doing.
Neil. Thanks. Hi, Chair Powell. Neil Irwin with Axios. We've only been running a little above 100,000 jobs a month on payrolls the last 3 months. Do you view that level of job creation as worrying or alarming, or would you be content if we were to kind of stick at that level? And relatedly, one of the welcome trends of the last couple of years has been labor market steam coming out through job openings falling rather than job losses. Do you think that trend has further to run, or do you see risk that further labor market cooling will have to come through job losses?
So on the job creation, it depends on the inflows, right? So if you're having millions of people come into the labor force, and you're creating 100,000 jobs, you're going to see unemployment go up. So it really depends on what's the trend underlying the volatility of people coming into the country. We understand there's been quite an influx across the borders, and that has actually been one of the things that's allowed the unemployment rate to rise. And the other thing is just the slower hiring rate, which is something we also watch carefully. So it does depend on what's happening on the supply side. And on the beverage curve question, yes. So we all felt on the committee, not all, but I think everyone on the committee felt that job openings were so elevated that they could fall a long way before you hit the part of the curve where job openings turned into higher unemployment, job loss. And yes, I think we are. It's hard to know that you can't know these things with great precision, but certainly it appears that we're very close to that point, if not at it, so that further declines in job openings will translate more directly into unemployment. But it's been a great ride down. I mean, we've seen a lot of tightness come out of the labor market in that form without it resulting in lower employment.
Thanks, Chair Powell. Edward Lawrence, Fox Business. So we've heard some speculation that you may be going with the federal funds rate to 3.5%, maybe under 4%. And there's basically an entire generation that has experienced zero or near zero federal funds rate. Now, some think we're heading in that direction again. What's the likelihood that cheap money is now the norm?
So this is a question. You mean after we get through all of this? It's just a great question that we can only speculate about. Intuitively, many people anyway would say we're probably not going back to that era where there were trillions of dollars of sovereign bonds trading at negative rates, long-term bonds trading at negative rates. And it looked like the neutral rate might even be negative. So people were issuing debt at negative rates. It seems that's so far away now. My own sense is that we're not going back to that. But honestly, we're going to find out. But it feels to me and that the neutral rate is probably significantly higher than it was back then. How high is it? I just don't think we know. We only know it by its works.
And one more. How do you respond to the criticism that will likely come that a deeper rate cut now before the election has some political motivations?
Yeah, so this is my fourth presidential election at the Fed, and it's always the same. We're always going into this meeting in particular and asking what's the right thing to do for the people we serve, and we do that, and we make a decision as a group, and then we announce it, and that's always what it is. It's never about anything else. Nothing else is discussed, and I would also point out that the things that we do really affect economic conditions for the most part with a lag. So nonetheless, this is what we do. Our job is to support the economy on behalf of the American people. And if we get it right, this will benefit the American people significantly. So this really concentrates the mind. And it's something we all take very, very seriously. We don't put up any other filters. I think if you start doing that, I don't know where you stop. And so we just don't do that.
Jolene.
Thank you, Chair Powell. I'm Jolene Kent with CBS News. My first question is, very simply, what message are you trying to send American consumers, the American people, with this unusually large rate cut?
I would just say that, the U.S. economy is in a good place, and our decision today is designed to keep it there. More specifically, the economy is growing at a solid pace. Inflation is coming down closer to our 2% objective over time. And the labor market is still in solid shape. So our intention is really to maintain the strength that we currently see in the U.S. economy. And we'll do that by returning rates from their high level, which has really been, the purpose of which has been to get inflation under control. We're going to move those down over time to a more normal level over time.
Just a quick follow-up to that. Listening to you talk about inflation moving meaningfully down to 2%, is the Federal Reserve effectively declaring a decisive victory over inflation and rising prices?
No, we're not. So inflation, what we say is we want inflation, the goal is to have inflation move down to 2% on a sustainable basis. And, we're not really, we're close, but we're not really at 2%. And I think we're going to want to see it be, around 2% and close to 2% for some time. But we're certainly not doing, we're not saying mission accomplished or anything like that. But I have to say, though, we're encouraged by the progress that we have made.
Hi, Katerina Saraiva with Bloomberg News. I just would love to know kind of how the committee is thinking about the persistence we've seen in housing inflation. Do you think you can return to 2% with housing inflation where it is? Yeah.
So housing inflation is the one piece that is kind of dragging a bit, if I can say. We know that market rents are doing what we would want them to do, which is to be moving up at relatively low levels. But they're not rolling over. The leases that are rolling over are not coming down as much, and OER is coming in high. So, it's been slower than we expected. I think we now understand that it's going to take some time for those lower market rents to get into this. But, the direction of travel is clear, and as long as market rents remain, relatively low inflation over time, that will show up. Just the time it's taking now, several years rather than just one or two cycles of annual lease renewals. So I think we understand that now, but I don't think the outcome is in doubt. Again, as long as market rents remain under control, the outcome is not in doubt. So I would say it's the rest of the portfolio, or of the elements that go into core PCE inflation have behaved pretty well. They all have some volatility. We will get down to 2% inflation, I believe, and I believe that ultimately we'll get what we need to get out of the housing services piece too.
Some of your colleagues have expressed concern that with starting to cut rates, you could reignite demand in housing and see prices go up even more. What's the likelihood of that, and how would you react to that?
So the housing market, it's hard to game that out. The housing market is in part frozen because of lock-in with low rates. People don't want to sell their home, so because they have a very low mortgage, it'd be quite expensive to refinance. As rates come down, people will start to move more, and that's probably beginning to happen already. But remember, when that happens, you've got a seller, but you've also got a new buyer in many cases. So it's not obvious how much additional demand that would make. I mean, the real issue with housing is that we have had and are on track to continue to have not enough housing. And so it's going to be challenging. It's hard to zone lots that are in places where people want to live. It's all of the aspects of housing are more and more difficult. And where are we going to get the supply? And this is not something that the Fed can really fix. But I think as we normalize rates, you'll see the housing market normalize. And I mean, ultimately, by getting inflation broadly down and getting those rates normalized and getting the housing cycle normalized, that's the best thing we can do for householders. And then the supply question will have to be dealt with by the market and also by government.
Victoria.
Hi, Victoria Guida with Politico. Just following up on some of the labor market talk earlier, monetary policy operates with long and variable lags, and I'm wondering how much you see being able to keep the unemployment rate from raising too much comes from the fact that you're starting to act now, and that's going to give people more room to run versus just the labor market is strong. And then also, if I could, following up on Nick's question, do you see today's 50 basis point move as partially a response to the fact that you didn't cut in July, and that sort of gets you to the same place?
So you're right about lags, but I would just point to the overall economy. You have an economy that is growing at a solid pace. If you look at forecasters or talk to companies, they'll say that they think 2025 should be a good year too. So there's no sense that the U.S. economy is basically fine. If you talk to market participants, I mean, business people who are actually out there doing business. So I think our move is timely. I do, and as I said, you can see our 50 basis point move as a commitment to make sure that we don't fall behind. So you're really asking about your second question. You're asking about July, and I guess if you ask, if we'd gotten the July report before the meeting, would we have cut? We might well have. We didn't make that decision, but we might well have. I think that's not. That doesn't really answer the question that we ask ourselves, which is let's look. At this meeting, we're looking back to the July employment report, the August employment report, the two CPI reports, one of which came, of course, during blackout, and all of the other things that I mentioned. We're looking at all of those things, and we're asking ourselves, what's the policy stance we need to move to? It's clear that we literally everyone on the committee agreed that it's time to move. It's just how fast do you go, and what do you think about the path forward? So this decision we made today had broad support on the committee, and I've discussed the path ahead.
Elizabeth. Thank you, Chair Powell. Elizabeth Schulze with ABC News. Mortgage rates have already been dropping in anticipation of this announcement. How much more should borrowers expect those rates to drop over the next year?
Very hard for me to say. That's from our standpoint. I can't really speak to mortgage rates. I will say, that'll depend on how the economy evolves. Our intention, though, is we think that our policy was appropriately restrictive. We think that it's time to begin the process of recalibrating it to a level that's more neutral rather than restrictive. We expect that process to take some time, as you can see in the projections that we released today. And if things work out according to that forecast, other rates in the economy will come down as well. However, the rate at which those things happen will really depend on how the economy performs. We can't look a year ahead and know what the economy is going to be doing.
What's your message to households who are frustrated that home prices have still stayed so high as rates have been high? What do you say to those households? Well,
what I can say to the public is that we had a burst of inflation. Many other countries around the world had a similar burst of inflation, and when that happens, part of the answer is that we raise interest rates in order to cool the economy off, in order to reduce inflationary pressures. It's not something that people experience as pleasant, but at the end, what you get is low inflation restored, price stability restored. And a good definition of price stability is that people in their daily decisions, they're not thinking about inflation anymore. That's where everyone wants to be, is back to what's inflation. We just keep it low, keep it stable. We're restoring that. So what we're going through now really it will benefit people over a long period of time. Price stability benefits everybody over a long period of time just by virtue of the fact that they don't have to deal with inflation. So that's what's been going on. And I think we've made real progress. We don't tell people how to think about the economy, of course. And of course, people are experiencing high prices as opposed to high inflation. And we understand that's painful.
Greg.
Hi, Chair Powell. Greg Robb from MarketWatch.com. I was wondering if you could go through, you said just at the beginning that coming into the blackout, there was like an open thought of 25 or 50. The Fed could move either 25 or 50. I would sort of argue that when we had those two last speeches by Governor Waller and New York Fed President John Williams, that they were sort of saying that maybe a gradual approach was going to win the day. I mean, I sort of want to ask a 7-part question about this, but I mean, could you talk, would you have cut rates by 50 basis points if the market had been pricing in like low odds of a 50-point move like they were last Wednesday? You know, after the CPI number came out, it was a really small probability of a 50-point cut. Does that play in your consideration at all? Just talk a little bit about that. Thank you.
We're always going to try to do what we think is the right thing for the economy at that time. That's what we'll do. And that's what we did today.
Simon.
Thank you, Chair Powell. Simon Rabinovich with The Economist. You've mentioned how closely you're watching the labor market, but you also noted that payroll numbers have been a little bit less reliable lately because of the big downward revisions. Does that put your focus overwhelmingly on the unemployment rate? And given the SEP projection of 4.4 basically being the peak in the cycle, would going above that be the kind of thing that would trigger another 50 basis point cut?
So we will continue to look at that broad array of labor market data, including the payroll numbers. We're not discarding those. I mean, we'll certainly look at those, but we will mentally tend to adjust them based on the QCEW adjustment, which you referred to. There isn't a bright line. It will be, the unemployment rate's very important, of course, but there isn't a single statistic or a single bright line over which that might move that would dictate one thing or another. We'll look at each meeting, we'll look at all the data on inflation, economic activity, and the labor market, and we'll make decisions about is our policy stance where it needs to be to foster over the medium term our mandate goals. Yeah, so I can't say we have a bright line in mind.
Matt Egan.
Thanks, Chair Powell. Matt Egan from CNN. I know that you discussed earlier how the Fed does whatever the right thing is and nothing else factors in. But in general, can you talk about whether or not you believe a sitting U.S. president should have a say in Fed decisions on interest rates? Because that's something that former President Trump, who obviously appointed you, has previously suggested. And I know the Fed is designed to be independent, but why? Can you tell the public why you view that so important?
Sure. So countries that are democracies around the world, countries that are sort of like the United States, all have what are called independent central banks. And the reason is that people have found over time that insulating the central bank from direct control by political authorities avoids making monetary policy in a way that favors maybe people who are in office as opposed to people who are not in office. So that's the idea, is that, and I think the data are clear that countries that have independent central banks, they get lower inflation. And so we do our work to serve all Americans. We're not serving any politician, any political figure, any cause, any issue, nothing. It's just maximum employment and price stability on behalf of all Americans. And that's how the other central banks are set up too. It's a good institutional arrangement, which has been good for the public. And I hope and strongly believe that it will, continue.
Kyle.
Kyle Campbell for American Banker. Thanks for taking the questions, Chair Powell. A couple regulatory developments in the past week that I want to ask you about. First, last week, Vice Chair for Supervision, Michael Barr, outlined his views for the changes to the Basel III Endgame. I'm wondering if you are in alignment with him on what those changes should be, if those have support on the board in a broad way that you're looking for, and if you think the other agencies are also fully on board with that approach. And then yesterday, other banking regulators.
You know what? Hold the second question.
Okay, sure.
Let me we'll give you the second question. So the answer to your question is that, yes, those changes were negotiated between the agencies with my support and with my involvement, with the idea that we were going to repropose the changes that Vice Chair Barr talked about, and then take comment on them. So yes, that is that's happening with my support.
And is there a date for that?
That's not a final proposal, though. You understand? We're putting them out for comment. We're going to take comment and make appropriate changes. We don't have a calendar date for that. And as for the other agencies, the idea is that we're all moving together. We're not moving separately. So that I don't know exactly where that is, but the idea is that we will move as a group to put this again out for comment, and then it'll come. The comments will come back 60 days later, and we'll dive into them, and we'll try to bring this to a conclusion sometime in the first half of next year.
Right. And then yesterday there were merger reform finalizations from the other bank regulators. What does the Fed have to do to align itself on merger?
I would bounce that question to Vice Chair Barr. It's a good question, but I don't have that today. Thanks.
Jennifer for the last question. Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said earlier that the decision today reflects with appropriate recalibration strength in the labor market that can be maintained in the context of moderate growth. Even though the policy statement says you view the risks to inflation and job growth as roughly balanced. Given what you've said, though, today, I'm curious, are you more worried about the job market and growth than inflation? Are they not roughly balanced?
No, I think, and we think they are now roughly balanced. So if you go back for a long time, the risks were on inflation. We had a historically tight labor market, historically tight. There was a severe labor shortage, so very hot labor market, and we had inflation way above target. So, that said to us, concentrate on inflation, and we did for a while, and we kept at that. The stance that we put in place 14 months ago was a stance that was focused on bringing down inflation. Part of bringing down inflation, though, is cooling off the economy and a little bit cooling off the labor market. You now have a cooler labor market in part because of our activities. So what that tells you is it's time to change our stance. So we did that. The sense of the change in the stance is that we're recalibrating our policy over time to a stance that will be more neutral. And today I think we made a good, strong start on that. I think it was the right decision, and I think it should send a signal that that we're committed to coming up with a good outcome here.
Is the economy more vulnerable to a shock now that could tip it into recession?
I don't think so. I don't. As I look. Well, let me look at it this way. I don't see anything in the economy right now that suggests that the likelihood of a downturn is elevated. Okay, I don't see that. You see growth at a solid rate. You see inflation coming down, and you see a labor market that's still at very solid levels. So I don't really see that. No, thank you.
Thank you.
Fed Chair Jerome Powell speaking following the latest decision here by the Fed to cut by 50 basis points. And Josh, a couple of things stuck out to me from Powell's commentary there just a few moments ago. One was just his commentary surrounding the reason why they went 50. And he basically said it's not an admission that the Fed was behind the curve, but rather he went on to say that's reflective of their commitment to stay ahead of the curve and not fall behind, putting to rest maybe some of those fears. I don't know, putting them to rest, but maybe easing some of those fears, at least for now, that maybe that 50 had been some sort of admission that the economy wasn't on as strong a footing as initially expected or at least hoped for by the market. And then also I think the market's reaction to some of his commentary. We initially saw a spike, fell to negative territory. Now we're back slightly higher across all three of the major averages. And I think this shows just much of that 50 maybe had already been priced in, but I think investors are trying to figure out exactly what the roadmap looks like for the Fed going forward, rather than just focusing on that 50 decision.
Yeah, some other comments that struck me, Sean. Powell said there was broad support for today's decision among Fed officials, talked about a lot of common ground despite Governor Bowman's dissent. Said the focus has been inflation, appropriately so. The tightening cycle, he said, paid dividends, inflation cooled, but then said the risk to the goals of stable prices and full employment roughly in balance. In other words, it sounds like they're shifting focus. On politics, I think we have to bring that up too. He was asked that, this kind of risk of could there be political blowback when you do half a point right before an election. Basically, Powell said, listen, our job is to support the economy. If we get it right, it benefits the American people. In other words, keeps pounding the table. The Fed here is apolitical.
Yeah, and I thought his message to Americans, too, that the economy was in good place, that they're focused on keeping it there was also significant to note as well. Well, as we've been speaking, we have stocks back in negative territories. Let's kick it over to Jared Blickery, who has a closer look at some of the seesaw action. Jared.
Thank you, Shauna. A really interesting reaction. And let's go to the Wi-Fi Interactive and plot exactly what went down today. This big spike is 2 p.m. That's when the announcement was released. Then we got a little bit of a pullback. And when Powell was talking, just kind of a lot of back and forth. I think it's instructive. We are now at the lows or toward the lows of the day in negative territory. But this is a very small number, 18 basis points, not a big move to the downside. S&P 500, the chart looks similar. It happens to be positive right now, falling on the northern side of the unchanged line. And then you take a look at the Russell 2000, that's bucking the trend a little bit because it's retaining more of its gains. But, you know, for 50 basis points, you might have expected more juice for risk equities. But I think by going to 50 basis points, Powell might have been subtly hinting that there's a greater chance of recession. But that's just an interpretation. He did not say that. But I think that's going to be first and foremost in traders' minds. They're going to be on heightened recession alert. And the next time we get a negative ISM print, or below 50 rather, we get a jobs number that goes negative, I think we're going to see an outsized reaction in stocks to the downside. Now, looking at the spider sectors here, we got energy in the top spot, industrials also up about 0.25%, utilities and tech. Theoretically, they should be benefiting from lower rates, but they are holding the line there. I just remembered I got to take a look at the bond market, and we're going to go to the 10-year T-note yield. That was up about 4 basis points before the announcement, and it's right back up there now. Shauna.
Almost unchanged. All right, Jared, thanks so much for breaking down today's action here. We want to welcome back in Threadneedle Ventures founder Ann Berry. We also have Greg Dacco, EY's chief economist. And guys, thanks so much for sticking around. So now we've heard from Powell himself. And I'm going to go to you first, just in terms of the market reaction to some of Powell's comments. What is your takeaway just in terms of what investor sentiment is at this point after we heard from Powell once again reiterating the fact that he doesn't think the economy is heading for a recession?
And he was completely clear and explicit on that. He finished by saying there's no sign of a downturn coming. So I think, go back to Jared's points, it looks as though the market is going to be flat. And it's kind of saying Jay Powell met our expectations. When you really cut through all the verbiage, which I thought was reassuring, it's the market saying we got it right.
Greg, you were listening to that presser. What, in your opinion, was Jay Powell's objective in that presser, and do you think he stuck the landing on it?
I think he did. Generally speaking, I think he did a relatively good job. I think there were 3 elements that I'll remember from this press conference. Number 1, he talked about recalibrating monetary policy. That's what we were talking before, recalibrating closer to a neutral stance. Number 2, he highlighted optionality. The Fed is not on a preset course. And number 3, he has a lot of influence on policymakers. He talked about the decision process. I don't think most were necessarily on board to start the meeting with a 50 basis point rate cut. They mostly ended with this view that a 50 basis point rate cut was appropriate. So a lot of influence from Powell there.
Talk to us about the significance of that, and maybe can we glean anything about maybe what that means for future decisions? Because he was asked point blank, what is the data point that he is going to be paying most close attention to that's going to then help them determine whether they're going to go 25 or 50 if they do decide to cut at the next meeting? He didn't really answer it. He said that he was going to be data dependent, but I'm curious from your perspective, is there one piece of data that you think is most important?
That's the one thing I think was the key downside in terms of his performance, was the fact that he remained very much data dependent. One thing where he was asked whether this was a catch-up effect and whether he would have made a different decision had he had the July employment report in hand, he said yes, we might have. So that is an indication that there still remains a lot of data dependency that will influence the Fed's decision-making process. I wanted to see a little bit more of a forward-looking perspective and where we're headed and how fast we're headed. There's still a lot of data dependency in his speech.
Sure. And let me get your take on the market reaction. So we were up, we were down, now I'm looking, we're back in the green. What do you make of it?
Well, I think the market's just trying to figure out what this really means. They're still interpreting whether there's no recession outlook. As credible I think it is. The one piece of data I did hear called out was wage inflation. As I listened to the presser, he did say wage inflation is above where perhaps we would want it to be in order for our 2% overall inflation level to be hit. So I think That's one I would be looking at, both from a market perspective, but also from an economic data point perspective. I think it's important.
And another piece that he was asked about, he's asked about so many things, but one thing that stuck out to me was some of his commentary surrounding housing. And I'm curious, Greg, from your perspective, just your assessment of the housing picture now that we do have a 50 basis point cut, is that really going to move the needle at all within the housing market?
Well, I think one key element in this decision was the asymmetry of risks to the upside and downside. If the Fed had done less than expected, the risk would have been a repricing of rates higher. So you would have seen mortgage rates actually go the opposite direction. I think it's very encouraging not to see much reaction in the markets because essentially the Fed did what was largely expected over the last couple of days. The risk would have been that yields rise rapidly and that hits mortgage rates, consumer rates, auto loan rates, and that deters private sector activity. So the risks were not balanced in terms of the Fed's decision.
Let me ask you, let's say, you're at a barbecue this weekend. You're talking to your friends and family.
Yeah.
They say, Greg, I heard the Fed did some kind of historic supersized cut, and they ask you, but what does it mean for me, actually, in my life as a consumer? How would you respond to that?
It's very interesting because that's a question that I actually get a lot of.
I'm sure, yeah.
You actually have a fairly limited effect of the Fed's easing or tightening because it's 25 basis point increments. If you look at adjustable mortgage rates, they based off of the Fed funds rate plus a premium. So that 25 basis point, 50 basis point doesn't do a whole great deal in terms of stimulating or cutting economic activity. Same for consumer rates and auto loan rates. But if you have a broad rise in rates of 50 basis points or higher in the opposite direction, that can rapidly deter economic activity. So think of 30-year mortgage rates, which are based off of longer-term yields. They could have risen much more, and all of a sudden, first-time home buyers might have been on the sidelines saying, hey, I'm not going in, I'm waiting a little bit more.
And one of the things that we were talking about going into this presser from Powell was whether or not this was a proactive move, whether or not this was a reactive move, and maybe where the recession risk lies. Just based on his commentary there, have you at all been swayed in one direction or the other?
I haven't, and he was explicitly asked the question whether this was a reaction to the change in the market's expectations, and as he did on the political question, he said, no, we're independent, we're data dependent. I think if there's one thing I always find disappointing about these pressers, nobody asks the question, are you guys going to start using different data sets? Right, and Greg, you made this point beforehand. Everything is backward looking. We're in the age of incredible data collection, incredible technology. What is the Fed doing, like the ECB is doing, which is publicly talking about what different kinds of data can help them be better forward looking? I'd like to hear that.
You think that they should be doing?
I think they should be doing it. We should be asking about it, and it should be an open discussion.
What do you think of that, Greg?
Yeah, I think we have a great amount of data. They're starting to use some private sector data. They've referred, Powell has referred explicitly to the Indeed wage tracker data, for instance, as a good measure of wage inflationary pressures. That's part of the reason why I think he's not seeing any additional wage pressures coming out of the labor market and inflationary pressures coming out of the labor market. So there is that move, but it's very gradual, and I would fully agree with you that it's not rapid enough in terms of the new data sets that are available.
Greg, Ann, thank you so much for joining the show today. Appreciate it both. Thank you. That does conclude our bonus Fed Day coverage. Market domination begins right on the other side. Stick around.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is Market Domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
Welcome back. It's time for Market Domination. I'm Shauna Smith alongside Josh Lipton. Let's take a look at the market action because if you've missed it, it's somehow been a very, very volatile hour or so here, Josh. And you can see that highlighted on the right side of the screen. Right now, you're looking at the Dow up just about 0.2%. Not a huge move here to the upside. You might be asking yourself, why aren't we seeing more of a reaction on the heels of a 50 basis point print? And a lot of it is because much of this had already been priced in. When you talk about the expectations, we have the Dow flipping back into negative territory once again. You have the S&P right along the flat line. We take a look at the Nasdaq, seeing some gains there, but again, not that huge move to the upside that we initially saw right after the announcement of the 50 basis point cut.
To your point, we rallied into it. I mean, record highs. Just a quick note in terms of how many people were actually expecting this. I thought this was interesting. Just 9 forecasters in Bloomberg's survey of 113 economists, I think they said, saw a half point coming, which does kind of mirror what we heard on this show. I mean, there was some notable, Greg Ip, the very smart columnist from the Journal, he wanted to see a half point cut, but most folks came on this show said, it's going to be 25.
Yeah, and we saw that the market, some were saying that the market's a bit too optimistic about wanting a 50 basis point cut, but they got what they wanted. And take a look at the bond market reaction. We are seeing a bit of a move to the upside at this point with yields up just about 4 basis points at 368. But again, we have been all over the map ever since that decision was released. Well, the Federal Reserve making the decision to cut interest rates by 50 basis points. Fed Chair Powell voicing the rate cut decision should be taken as a sign of the central bank's commitment not to fall behind the curve. Here with more is Yahoo Finance's Jennifer Schomburger. Hey, Jen.
Hey, Shauna, that's right. Fed Chair Jay Powell defending the committee's move to cut by 50 basis points this afternoon, saying that the Fed is not behind the curve, but that the move is more preservation for strength of the economy and the job market. He also said he does not think the economy is vulnerable to a shock right now, and that he does not think the odds for a recession have risen. Take a listen.
Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a half percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%.
Powell said the 50 basis point rate cut is a commitment that the Fed doesn't fall behind. He said that the Fed may have cut in July had they seen the July jobs report in advance, but that today's decision was looking back at both the August and July jobs reports. Take another listen.
We don't think we're behind. We do not think we think this is timely, but I think you can take this as a sign of our commitment not to get behind.
Powell said that the decision was one that was broadly supported, and the logic for the decision was from a risk management and economic standpoint. He said that they opted to go bigger after thinking that payroll numbers may have been artificially high, also as well after seeing anecdotal evidence from the Beige Book that showed weakening in the job market. He said clearly job market conditions have cooled, but are still at a level that would be considered maximum employment. Not declaring a victory on inflation yet, he says looking ahead, the committee is going to take decisions meeting by meeting, and that if there were a swift deterioration in the job market, that could cause the Fed to move faster. Guys?
Jennifer Schomburger, thank you. The Federal Reserve's highly anticipated rate cut is here. Central bank lowering interest rates for the first time in 4 years. Fed officials cutting its benchmark interest rate by 50 basis points. Lower rates potentially making for a bullish recipe for tech stocks. Here to discuss is Wedbush Managing Director and Senior Equity Analyst Dan Ives. Dan, always great to have you on the show. Perfect timing. So the Fed, Dan, they cut by 50. We got the AI revolution, in your words. That's here. Full steam ahead for the tech trade, Dan?
I think tech rips higher into year end. I mean, once this is all digested, because in terms of where this is all heading, I mean, you got spending that we actually believe is increasing based on just coming back from Asia from a chip perspective. Got the AI revolution led by NVIDIA, Microsoft, but now second, third, fourth derivatives playing out, Palantir and others. And now this soft landing, Fed's cutting, it's a risk on. I mean, going into year and into next year, I view this very bullish for tech stocks.
Dan, you just mentioned the fact that you were over in Asia. I'm curious what you've learned from a supply chain standpoint. And when you talk about the fact that this is a risk-on trade right now and you're confident of tech's move higher, I'm curious, because of that rate cut, are there any specific sectors or areas within tech that you think are poised to benefit the most?
Yeah, I mean, demand's outstripping supply 15-1 from a chip perspective. It's actually incrementally more bullish than even a few months ago when we were in Asia because of enterprise demand. And look, NVIDIA is the only game in town now, but the use cases are exploding. That's bullish for hyperscalers. You look at Microsoft, Google, of course, Amazon. And I think it just shows this is about $1 trillion of incremental AI CapEx over the next 3 to 4 years. Big tech's leading it. The sovereigns ultimately will get it from a government perspective and other enterprise. And that's why I view it. This is still 9 p.m. in the AI party that goes to 4 a.m.
Dan, let me get your take on one big theme that played out this earnings season, which was big tech was spending on AI, but investors had some new questions, right? I mean, you did hear that kind of bubbling up. Where is the actual return on all this AI investment? How are you thinking through that dynamic, Dan?
Yeah, look, Josh, you obviously know tech, as well as anyone. I think we're in between this sort of CapEx massive tidal wave and where you've actually seen the numbers come out where you're going to see the monetization from a software perspective. You've seen it in Microsoft, seen it in Oracle, seen it in Palantir, ServiceNow. But the second, third, fourth derivatives, all of our checks are showing when we go into December, you go into March, you go into June in 25, that's where I think numbers come up significantly higher. And I think that's where, even though we've seen some sort of soft spots, obviously with Salesforce a few quarters ago and others, I believe this is just an air pocket, and ultimately we're going to see numbers go a lot higher for software.
Dan, are there any macroeconomic risks, though, that you are a bit worried about? You're viewing rate cuts as a bullish move or a bullish sign here for tech, but just more broadly speaking, that risk of recession is still not going anywhere, right? Some on Wall Street are still worried about that. Are there any macroeconomic factors that you're closely watching?
The bears have been worried about recession the last 2 years, while tech's just continued to rip higher. And they'll come out of hibernation mode here and there over the coming months. You got the election, of course, in terms of some of the risks. But it just, as we talked about, this is a fourth industrial revolution. And that's not changing if it's 25. It was 50 bips. It's not changing regardless of who's going to be president. This is an unprecedented tech spending environment. Fed cutting, I believe, just makes it more of an autobahn in terms of what we're seeing for tech. I'm not saying everyone's going to benefit, but in terms of the AI revolution, the winners, that's why I believe over the next 3 to 6 months, we're looking at Nasdaq 20,000.
Dan, while I have you, let's switch gears a bit here. Talk Apple, another name you cover. Big day on Friday, that new iPhone hitting store shelves. How should we as investors think about that, Dan? Is this going to be another iPhone supercycle?
Look, I mean, it's a matter of when, not if, that this is an iPhone 16 supercycle, an AI-driven one. Now, obviously, a lot of, the bears talking about pre-orders and trying to, obviously scared many investors earlier this week. Josh, in Asia, no one was expecting pre-orders to be up massively. It's actually in line with expectation. This is all about as Apple Intelligence rolls out into the December quarter, into March. That's why I believe this will be the largest Apple iPhone cycle that we've seen. I think markets better digesting it the last few days, but we're going to continue to sort of navigate. I mean, the haters will continue to hate on Apple, but I believe this is ultimately a $4 trillion market cap in what I believe in 2025.
Dan, talk to me about the catalyst that you think this is going to be. I guess more specifically here, when you take a look at Apple over the next couple of months leading up to this super cycle, how much of that has already been priced in the near term?
Oh, I don't think it has. I mean, I think actually markets underpricing where units go. I think units could ultimately be up high single digits, potentially double digits. Market call it 5% in terms of overall growth. 300 million, and this is most important, that 300 million iPhones have an upgrade in 4+ years of 1.5 billion iPhones. That's setting up for an unprecedented upgrade cycle. And look, the AI revolution now is coming through Cook and Cupertino. And I believe 20% of the world over the coming years will access AI through an Apple device. And I just think this is one where the street is underestimating what the consumer AI revolution is going to mean to Apple stock.
Finally, Dan, Palantir, another name I know you like, getting added to the S&P 500. I know you're a fan of Palantir. Dan, how big a milestone is that for Alex Karp's company?
The Messi of AI. I mean, this is the validation for Karp and the team. Remember, institutional investors, thought this was, going to continue to sort of be a kindergartner as a stock. But ultimately, we said bull case $50 because this is probably the best pure play AI name in the market. And I don't think they're done. They're actually just beginning, which is why you could see ultimately a senior citizen as a stock here.
Dan, always appreciate you having you on the show. Thank you, my friend.
Thank you.
Coming up, shares of General Motors riding higher today. We're going to check in on some of today's top trending tickers when market domination returns.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement. Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetnista, your favorite financial educator. Welcome to Capital Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Now time for some of today's trending tickers. You can scan the QR code below to check out the best and the worst performing stocks of the session on Yahoo Finance's trending tickers page. First up today, GM, General Motors. After months of delays, GM's electric vehicle owners can now finally recharge at Tesla supercharger stations. GM supercharger access was supposed to begin in the spring, but software delays on Tesla's side reportedly kept pushing it back. Now, though, GM EV owners can use almost 17,800 supercharger stations across the U.S. and Canada. However, the vehicles still need adapters, and those are proving hard to come by. And we talk about the fact that this could be a huge win just in terms of maybe getting more people interested in buying an EV, given the access that they now have to superchargers. Obviously, the delay wasn't ideal here for GM, but many GM owners are very happy. Of course, the question is what this signals going forward and whether or not it's going to help boost demand.
Yeah, GM has been pushing into EVs, so new sub $50,000 models. And Bloomberg noted, by the way, plant in Mexico, increasing output of the Chevrolet Equinox EV. The Chevy Blazer EV, which starts at $49,000. So now, to your point, Sean, with also expanded charger access, the question is, how much of a tailwind is that for the EV sales? We shall see.
Yeah, and the adapters cost $225. Not too cheap.
No. All right, our next trending ticker, Super Micro Computer. That stock moving higher in today's trade after Needham initiated coverage with a buy rating and $600 price target, calling it the coolest kid, Shauna, in AI town. That's a title. I like that title. So why do they say that, by the way? Well, here's their point. Company has first mover advantages thanks to its design of GPU-based compute systems and liquid-cooled rack-level solutions. Says the company is a significant beneficiary from growing investments in AI infrastructure. Says Supermicro, currently involved in the deployment of some of the largest AI clusters in the world, and entered fiscal 25 with a record high backlog.
Yeah, they're making the argument that they're extremely well positioned given the fact that they're going to be the significant beneficiary from the growing investment that we are seeing within AI infrastructure. I actually had the opportunity to speak with Supermicro's CFO earlier in the summer, was asking him about the unprecedented demand that the company is seeing for its products. And he was saying it's very much a supply issue for them versus demand. And they're trying to do everything they can to meet supply. And he was very bullish on the outlook here for Supermicro going forward, saying that the opportunity that is presented right now is that huge demand, that they have a growing backlog because of the fact that they're bringing, in his words, really good products to market. So he was very bullish on the outcome. We know Wall Street has been pretty split on exactly what the upside still looks like here for Supermicro. But again, this analyst, Quinn Bolton, making the argument that they are going to be a significant beneficiary.
There has been some drama around this. Because remember, Hindenburg Research published that report, allegedly found glaring accounting red flags. Company said it was delaying filing its 10K for the fiscal year. Needham addressing that, saying, while we acknowledge the risk associated with the board's review of internal controls, we believe most of this risk may already be reflected in the current share price. Most on the street actually on a hold on this one, but not Needham. All right. Uncertainty over the Fed's pivotal September meeting and concerns about a slowing economy has had traders playing defense, with the Fed now cutting rates by 50 basis points and Powell reassuring their commitment to stay ahead of the curve. We're taking a look at how this shakes out the options market in this segment, sponsored by Tasty Trade. Amy Wu Silverman, RBC Capital Markets equity derivative strategist, joining us now to discuss. Amy, good to see you. So, heading into this Fed meeting, I'm just curious, Amy, as you were talking to clients heading into this big decision, what were you hearing, Amy? What were those clients telling you?
Yeah, look, we I think we've been talking about this ad nauseum. Honestly, I'm a little bit glad it's over. But we had a big client dinner last night, and so occasionally I just make people do show of hands. Do we think 25 or 50? And it was pretty 50-50 split, which was the pricing as well. But the interesting thing is, when I sort of pushed and said, look, if we do get this 50 basis point cut that supposedly we want, what do we think the stock market reaction is? And I would say the reaction was also 50-50 of whether or not this is necessarily good or not. And I think Powell had quite a fine needle to thread for that point. But I think we'll continue to see how this plays out in the days. I think it's still quite early, and it's not necessarily the case that all is well quite yet.
Amy, one of the things that you had pointed out in your notes ahead of this decision stuck out to me was the increase of positioning here and protections to the downside. Given the fact that we did get 50, and given the fact that maybe this does potentially raise the risk in the minds of some investors that we could see a recession, are you expecting to see maybe more of a move into that trade?
Yeah, it's a great question. And I'll tell you, when you just think about this year, I would just simply characterize the first half of this year as all about FOMO and MOMO. And we saw that in the options market through historic call buying and AI and NVIDIA and S&P and Qs. And then, you got that August 5th blip, if you will, in the VIX, that huge volatility spike, that drawdown. And even though things have kind of normalized on a headline level, underneath the surface, there's been a lot of tension. There's been a lot of uncertainty. We see that in an equity skew metric, which is essentially the demand imbalance between put options to play downside versus call options. And those have ticked up dramatically. I don't think it's necessarily just a Fed narrative. I think there's a lot of other volatility potholes as we head into the end of the year. But look, are people looking to hedge their portfolios? Yes, that's a conversation we're now having.
In terms of those potholes, Amy, what would be on your radar? Is it the election?
Certainly the election. Look, one scenario that came up yesterday that, I'm still noodling on is we have November 5th as the presidential election and November 7th is the next Fed meeting. And what if we're 2 days in and we haven't counted all the ballots, right? Like given how close this election is, I could see a scenario where we don't necessarily know yet who the next president of the United States is, and the Fed has to make a decision. They say politics doesn't matter, but look, could that influence their decision or not? I think those are the volatility potholes that investors are thinking about.
Amy, one of the arguments that Powell did make in defending the 50 basis point move was he was saying it wasn't so much reactionary or a sign that the Fed was behind the curve, but rather it was the complete opposite. They were doing this to stay ahead of the curve. Do you agree with that sentiment? Or I guess, where do you stand just in terms of what that reality then more realistically looks like?
I think that was really interesting. And to me, that's very much his needed to thread the needle, ahead of this. And I think first time will tell. The second thing I would say is going into this, there was a big concern just about, growth scare. And we saw that initially kind of during this first NFPs in early August, and the market did not react well to that. And then going into this Fed meeting, we didn't see much change in positioning, meaning it was quite sticky. And so I think from a derivatives perspective, we'll see in the coming days how much the market is buying his narrative on that.
And so, Amy, when you look at the options market right now, it's just, as you say, it's just not pricing in much upside here?
Yeah, one thing we like to look at is we take aggregate Sharpe ratios of just every stock in the S&P 500, meaning we take, the analyst price targets, a median on that, and compare that to the risk-free rate and just the volatility to get a risk-adjusted return. And when you look at how Sharpe ratios are doing historically, they're all declining, meaning the market itself is telling you that it really asymmetrically doesn't see as much upside as it does downside. Now, that doesn't necessarily mean we're going to get some massive drawdown. It just means that, the upside to where we are right now is fairly limited on an aggregate basis and on a sector by sector basis.
Amy, always great to see you. Thanks for coming on.
Thank you.
While we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
That's the closing bell on Wall Street. And now it's time for Market Domination Overtime, sponsored by Tasty Trade. Joined by Jared Blickery to get you up to speed on the action from today's trade. But first, let's see where the major averages closed the day. It has been a wild ride in the last 2 hours. Let's recap here. You've got the Dow closing off just over 100 points, giving back some of those earlier gains. You got the S&P off just about 0.3%. The Nasdaq also closing lower, off about 0.3%. But really taking a look at today's trading action, we got to look at this intraday chart because as you can see right here on the right side of the screen, we certainly saw a lot of volatility starting with that 50 basis point announcement. We saw a huge spike in the equity market here, was given away or gave back most of its gains pretty quickly. And then as Powell continued to talk, we actually fell into negative territory, and that is where we ended the day. Taking a look at the bond market, also some reaction there, although not a huge reaction. You got the 10-year yield right around 368, so still below that 3.7 level. And flipping over to the sector action here, lots of red on your screen. Energy, actually the only sector closing the day in the green. On the flip side, some of the worst performers there, you had consumer staples, utilities, and technology. The tech sector closing off just about 0.9%. Let's kick it over to Jared, who has a closer look at how stocks tend to trade following a rate cut. Jared, fill us in.
Well, thank you, Shauna. You know, with stocks at record highs here, it sets up a really interesting position for the Federal Reserve. Are they going to cut rates? Oh, well, they did cut rates. What is that going to do for stocks? And Brian Dietrich is posting the historical results and answer there. He's saying the Fed has cut rates with stocks near all-time highs 20 times. The S&P 500 was higher a year later 20 times. The S&P 500 is at highs now, and the Fed is cutting tomorrow. This was yesterday, but obviously the Fed did cut today, and you pull up his chart there, hard to see, but for the most part, stocks go up, right? And so we can ascribe any number of reasons to these moves, and on Fed Day, it's going to be because of the Fed. But I think with 50 basis points in the can right now, traders are going to be on heightened alert for any weak economic data. And I think one of the bigger headlines that we can take away from this report today is that bad news is bad news. So what portends for the future? That's what all traders, everybody wants to know, and we can't say for sure, but history favors the bulls. Josh?
Thank you, Jared. New survey from Edmunds finds that 62% of car shoppers are holding off on purchasing their next vehicle because of high interest rates, while 64% said a Fed rate cut would affect the timing of their next car purchase. So how will today's supersize 50 basis point cut impact car shoppers? Praz Sumeranian is here with more. Praz.
Hey, Josh. Yeah, so really interesting stuff here from Edmunds. You know, pandemic fuel prices, higher rates really hit car buyers in the last couple of years, but now we're seeing that. We're seeing how the effect could be, how big it could be. So 62% of Americans held off on that car purchase. Even younger buyers are more affected by this. 72% of buyers under the age of 44 were holding off on a car purchase, or they affected their timing because of higher rates. And also EV buyers, 74% of EV buyers said that the rates affected their sort of timing here. You know, that's not surprising given what's happening with high prices, but those are coming down recently, and that's sort of a good thing. Plus 50 basis points is actually, or should I say 50 half percentage points, kind of a big deal. Bank of America found that could affect as much as $20 per monthly payment, which doesn't sound like much, but 2/3 of Americans are living paycheck to paycheck here. So there is an effect here for Americans.
You know, President, we're trying to figure out, I guess, how exactly this is going to translate into demand, right? Just in terms of the fact that obviously $20 a month can be huge here if you're living paycheck to paycheck and you're trying to figure out how you are going to afford the next car. In terms of projections, are analysts expecting to see a significant bump? Is it supposed to be a slight uptick? I guess put that in perspective maybe for what investors could be expecting those returns to look like from some of those larger automakers.
I think it's going to be a modest bump for now, and then where the dot plot says 100 basis points by the end of the year, that could be very beneficial. But there's also costs for dealerships, so the cost of financing their entire floor, they call it, all their cars. That's kind of a big deal. A lot of the automakers have locked in long-term sort of bonds in place for their own financing, but short-term stuff, that can also affect in the margins too, just for the automakers, as well as customers too. They're looking for just every little buck they can get to get that new car. Because a lot of the America's fleet is aging. I think the average age is 12 years per vehicle. It's very old compared to other Western countries. So this could help kind of change that fleet, maybe get more EVs on the road too.
You think about the GM news today, GM EV customers, right? Now they get access to Tesla superchargers. And you combine that with the Fed decision, some tailwinds there maybe?
Yeah, I think so. I think with GM, it's a little bit sort of late here with that getting that Tesla plug-in to use those adapters, kind of a few months after Ford got that. But at the same time, GM's cheaper EVs are coming out now. The Equinox EV around $40,000 before tax credit. So that's kind of the right time here. You get these newer EVs coming. You get the Tesla adapters in place for 17,000 or so chargers. So I think that's good timing there for GM. And then also we're talking about financing coming down too. So we'll see.
All right, Pras, thank you. Appreciate it. It was a volatile final hour of trading on Wall Street after the Federal Reserve cut rates by 50 basis points. The Dow and S&P 500 pulling back from record highs earlier in the session. And joining us now is Mona Mahajan, Edward Jones Senior Investment Strategist. Mona, I'll be honest, I called this one totally wrong. I thought it was 25, Mona. I thought, you know what? The economic data has been decent just this week. I heard retail sales surprise the upside. I thought, you know what? Jay Powell and the gang, they're going to take it kind of slow and easy. They're going to do the normal 25. I was wrong, Mona. What do you make of it?
Yeah. You know, you weren't alone there. I think a lot of folks were worried that if they did 50 basis points, there would be some concern in the markets. Markets would be spooked that the Fed knows something we don't know and that perhaps the economy is much closer to recession than we all thought. Now, I think Jerome Powell did a nice job today of implementing the 50 basis point rate cut, but also then signaling very clearly that he does not think the economy is in any sort of imminent danger of a downturn or recession. In fact, he reiterated a few times the economy is holding up well, the labor market is in good shape, and this 50 basis point rate cut is a sign of confidence that inflation is moving much closer to their target 2% more than anything else.
Mona, what's your read? How confident are you that that is the case and that we're going to get a soft landing?
Yeah, you know, right now, the data is favorable that we are headed towards what we'd call that soft-ish landing. You know, when we think about some of the hard data points that we're watching, GDP growth, last quarter, 3%. This quarter, GDP now, that Fed projection of where the current quarter GDP is heading is also close to 3%. So 3%, keep in mind, well above even trend rates of 1.5% to 2%, but nowhere near negative growth rates. So that's a positive. Earnings growth is another underlying key factor for both the economy and the markets, frankly. And earnings growth rates, despite being revised lower for third quarter and fourth quarter, still look on track to grow about 10% year on year, which is another positive sign. And what we'd say broadly about the labor market, we are seeing a cooling, not a collapsing, but it's also been driven by new entrants to the workforce rather than those layoffs and job cuts that all of us and households across the country may be more worried about. So that's a good sign. We are seeing positive data points on the inflationary side as well. So net, we'd say headed towards that softish landing, but we are glad to see the Fed is taking some serious action to really play some catch up and get the Fed funds rate closer to a less restrictive and more neutral level.
Mona, what do you make of the market reaction? I'm just looking at all three averages. We're actually, edging lower again here. What do you make of that response?
Yeah, you know, it's interesting. Of course, we all watched the CME Fed Watch tool and market probabilities of what would happen today. And markets had started already pricing in a 50 basis point rate cut. Even as of Friday, it looked closer to 50-50. And then by the end of the day on Friday, we looked closer to maybe it was 70-30. And so the probability of 50 basis point rate cut was rising. But we'd say more broadly, if we take a step back, S&P 500 is up about 18% for the first 9 months of the year or so. That's a very strong growth rate. We are, of course, headed towards a historically choppier period of September and October, and headed straight towards that election day on November 5th. We know the period before elections can be volatile in markets, but notably, the couple months at the end of the year and even after election day, we do tend to see better market performance. So some of what we're seeing is a little bit of caution ahead of the seasonally choppy period, a little bit of caution as the data has shown some signs of slowdown, and as investors figure out whether they are, should be bracing for a recession or not. Doesn't seem like that is a base case for now. But what we would say is use any periods of volatility as an opportunity, because history has told us that if the Fed is cutting rates and the economy is not headed towards a recession, markets are well supported in that backdrop.
Mona, just pushing a little bit further then into that, where do you stand on the growth versus value trade? Is now the time to be a little bit more risky? And then when it comes to large cap versus small cap, where are you seeing that opportunity, or how should maybe investors be thinking about diversifying their portfolio?
Yeah, exactly the right questions to be asking, because Historically, again, when you think about Fed rate cuts, and this is a Fed that is poised to really embark on a multi-year rate cutting cycle. They have outlined a Fed funds rate that'll go from the 5.25% to 5.5%, probably somewhere closer to 3% range. And in that environment, what tends to happen is, one, when rates are moving lower, you do tend to see valuation expansion. And where are the areas that have the scope for more valuation expansion? Well, it's probably those parts of the market that are not, growth, mega cap tech, that have already seen a nice expansion, that have already seen multiples rise as well. And so what we'd say is we're certainly looking for diversification, probably maybe away from growth and into value, but more so a complementing of growth and value. So what we'd say is if the theme of your portfolios or of investments in general over the last 18 months or so was narrow portfolios are winning, tech growth is the place to be. When you look at the next 12 to 18 months, really you want to see balanced portfolios, this combination of growth and value, cyclical parts of the market, including areas like industrials, like utilities, even parts of financials that can do well when rates are moving lower. Important to have that balance in your portfolio. And to your question on large versus mid and small, we actually like still both large and mid cap here, because we think there's scope for diversification within both of those asset classes. They can do well in a Fed rate cutting cycle. We're a little cautious on small caps still because they do tend to be more highly leveraged, and they tend to be lower earners, a lot more of those quote unquote zombie companies in that cohort as well. But we'd say overall, make sure when you're looking at your portfolio and positioning yourself and taking advantage of those opportunities over the next few months, make sure it includes a combination of growth, value, cyclical, and large and mid cap stocks as well. So those are the places we would be as we head into this rate cutting cycle.
Mona, always good to see you. Thanks for joining us.
Thanks, guys.
Time now for what to watch Thursday, September 19th, sponsored by Tasty Trade. Starting off on housing, new weekly mortgage rate data from Freddie Mac out at 12 p.m. Eastern. The 30-year fix fell to 6.2% in the most recent reading. Rates have dropped 3 out of the last 4 weeks. With the Federal Reserve's 50 basis point cut earlier today, we'll see what impact the Fed's decision will have on the housing market going forward. But the cut will not be reflected in tomorrow's report.
Taking a look at earnings, we'll be getting some more from corporate America when you take a look at Lennar, FedEx, and Darden Restaurants. Lennar announcing results for the third quarter after the close, with mortgage rates retreating in today's interest rate decision. Analysts expecting Lennar sales incentives to be the focal point of the homebuilder's Q3 report.
And weekly jobless claims data out ahead of the opening bell. Economists forecasting 230,000 people filed for first-time benefits for a second straight week.
And tomorrow marks the lockup expiration for former President Donald Trump, which enables him and other insiders to sell shares of Trump Media. Trump saying last week that he does not intend to sell shares. His stake in the company is valued at more than $1 billion. GJT shares closed lower on the day.
And coming up, we're heading out to the Future Proof Festival in Huntington Beach, California, as Julie Hyman catches up with the CEO of Galaxy, Michael Novogratz. Stay tuned, you won't want to miss that conversation.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
I'm Julie Hyman at the Future Proof Festival in Huntington Beach, California. Big audience here of registered investment advisors and financial advisors. And of course, increasingly, crypto is a part of their portfolios. That is why Michael Novogratz is here. He's the CEO of Galaxy Digital, well-known crypto investor and advocate for quite a while now, in fact. Mike, thanks for being with us.
Thank you.
So I'm actually going to start in the political realm, and then we'll sort of get to price action and whatnot. Former President Trump has just said he is introducing some sort of new crypto product. It is called World Liberty Financial. It's unclear exactly what it is, but it's sort of just the latest step in his courting of the crypto community. I'm just curious what you make of this latest announcement.
Yeah, listen, I think, first of all, Trump realized, certainly before the Democrats, that there are 80 million crypto holders in America, and a lot of them are single issue voters. And it's a very passionate community. And so, like, being anti-crypto is a little bit like being anti-dog. It's just not smart politics. And so I think the Democrats are getting there, but Trump got there first. And, you know, the speech he gave at the crypto conference in Nashville, Tennessee, was kind of a crypto business owner's dream. And so, like, my role these days is to get the Democrats to have a rational and smart crypto policy, which I think they will. But we know if the Republicans win, it's really going to be, you know, opening the floodgates for crypto. His project, it seems strange that a candidate running for president will be launching a crypto project.
Is he hedging his bets?
I think his son, listen, the Trump family seems to love to, you know, throw their hat in on any business they can. And what worries me is some of these projects are fly-by-night and they raise money from retail investors and they don't follow through. And so we'll watch very closely. We're watching, not investing at this point. You know, he's got some credible people around the project. But one of the criticisms of crypto has been it has been rife for grift and graft and fraud. And so while we've asked for like smart regulation, not over-regulation, is, you know, so consumers have some protection.
Right.
And so these are the things that worry you when people hype something up. Price goes up, price goes down. Now listen, it's the same in stocks. I mean, the Truth Social stock is one of the most bizarrely valued stocks of all time. It's like a meme stock around President Trump. And so he hasn't been able to sell there yet, right? I'm sure if he could have sold stock, he would have sold a lot because he had a spectacular paper net worth in that stock.
He said he's not going to sell when the lockup ends.
Yeah, and you know, listen, if he sold, it would go straight down to almost nothing. And so it's one of those frustrating positions that, you know, in general, in the equity world, you need to build a company that at least the narrative feels true, that it's going to grow and that the momentum of growth is going to accelerate, right? The second derivative gets positive and you can get to crazy valuation. In crypto, it's a lot about distribution and building community. And so the more a project is distributed, the more stable it becomes. That's why Bitcoin is such like the stalwart in our whole ecosystem, because it's purely distributed at this point.
Very distributed.
Tons of people own it. And so each of those owners becomes a promoter of it. And so that's one of the unique parts of crypto that you don't necessarily get in other asset classes.
I want to ask you more about the political side because I'm curious, as somebody who is, I believe, a lifelong Democrat, does it pain you a little bit that the Dems and that the Harris campaign has not been more vocal, assertive about crypto? And are you having conversations with them now? Are you trying to, what are you trying to get them to talk about?
Let me say that it was unbelievably painful that the Biden administration was as bad on crypto as they were. Categoric, un-American, unfair. We've had an SEC that literally has lost many cases in court and just persists at being very difficult to deal with for crypto.
Do you think that...
I think Kamala Harris will pivot. I think she's a practicalist. I think she came from an innovation capital of America, so she sees what innovation does, right? She's from San Francisco, or Oakland. So far, the campaign has said they will be a pro-crypto candidate. That's all they've said. And I think they would have said a lot more if the campaign wasn't going so well. Like, she came into office and had this surge of enthusiasm, surge in the polls, and I think my own guess is they're doing a lot of listening and they're not doing a lot of talking because it's working.
Is that a mistake, though? Is that too complacent to sort of take that crypto vote for granted or to not talk about it?
Sun Tzu, I think crypto's a small piece of the arsenal for them. I think they're looking at that Sun Tzu quote, when your enemy is self-annihilating himself, just step back and allow him, I mean, the Trump campaign is making mistake after mistake after mistake, from eating dogs to, the debate performance. And so I'm hoping from a crypto perspective that they come out and make some more positive comments. I know there's a lot of meetings happening with her advisors, and I think her future transition team that is going to help shape policy. And quite frankly, there's not that much for the government to do. There is an attitude change. There's a market structure bill, a stable coin bill, a directive to the OCC to allow banks to hold crypto on their balance sheet, and some accounting changes. And then we wouldn't have to be in Washington for the next 10 years.
There's one thing you didn't mention that I want to ask you about. You mentioned Gary Gensler. Do you think Harris needs to remove him as head of the SEC?
100%. And I think he's at the end of his term. Like, I think certainly if Trump gets in, there's a different SEC. But if Harris gets in, I'm 96% certain Gensler won't be there. No one wants to start a new regime with someone with that much baggage at this point. And so we'll see what the SEC does in this interim period. How Gensler, does he try to pivot to act like he gets some things done so he can say, yeah, business as usual, or does he stay as stubborn as he's been on some of these issues? We'll see.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers,
and expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. The Federal Reserve goes big. The central bank cutting rates for the first time in 4 years, matching the market's expectations for a 50 basis point rate cut. But the news, not quite good enough for investors. After a volatile final hour of trade, major averages do close near their lowest levels of the day. The housing sector likely to see the biggest boost from falling rates. Mortgage rates already edging lower in recent weeks, and we're going to get expert insight with a look at what to expect if you're in the market to buy or sell a home. Plus, controversy over regulating AI. California Governor Gavin Newsom signing new bills targeting deepfakes in elections. But is this the right approach to cracking down on new technology? We're going to take a closer look. The Fed cutting interest rates by 50 basis points earlier today. Fed Chair Jerome Powell was asked about how the Fed expects to get back to its 2% target with housing inflation where it is.
But I think as we normalize rates, you'll see the housing market normalize. And I mean, ultimately, by getting inflation broadly down and getting those rates normalized and getting the housing cycle normalized, that's the best thing we can do for householders. And then the supply question will have to be dealt with by the market and also by government.
For more on how the Fed's decision will affect the housing market, we're bringing in Mickey Conlon and Tom Postilio, real estate brokers at Compass. Guys, welcome to the show.
Thanks so much. Thank you for having us.
Tom, I'll start with you. So let's start with the big news today. The Fed goes big, right? I was wrong. I thought 25. Jay Powell says we're doing 50, supersized cut. Yeah. Walk me through what you see that having in terms of the impact on your market, the real estate market.
Absolutely. Let me tell you what just happened. At Compass Global Headquarters, we just had a champagne reception with every New York City and Long Island.
Popping the champagne
We're
bottles.
popping the champagne. Because for the last 3 years, it's just been a lot of headwinds. But we're so excited about this, and we've seen over the course of the last several weeks, even coming out of August, which is typically a quiet time, August was the best August for signed contracts since 2017.
Wow, okay, and that's because expectations.
Expectations.
Yeah.
We knew that this was going to happen. Most people believed it was going to be a quarter of a point. I believe we all did.
We certainly did, yeah.
But half a point is big news.
Wow. And Mickey, I'm interested, curious now, let's look ahead a bit, right? So August, pretty good. Autumn, usually pretty good time, right, for real estate brokers. What do you see this autumn? What do you expect?
Well, this is interesting because August is typically a very sleepy month, and it was on fire. So heading into Labor Day, usually people are rubbing the sand out of their eyes and coming back from the beach. We hit the ground running. That's all in anticipation of today's announcement. But what's also an interesting factor here is that we're in an presidential election year. Usually the real estate market takes a long nap because people, regardless of who they're voting for, just want to wait and see. We've asked them in years past, what are you waiting to see? Just waiting to see. But it seems people have put that aside because there's so much pent-up demand, and there has been for 3 years, that buyers are finally, this announcement gave them permission to get off the fence. And that's what we've been looking forward to.
And Tom, where's the activity been? Has it been in certain segments of the market?
It's really
you really see the heat?
I mean, it's been across the board. We had a bidding war on a property that was just $1.5 million a few weeks ago. I mean, a statistic came out the first week right after Labor Day, we had the most signed contracts in the luxury sector, which is $4 million and above in New York City. The most signed contracts in a post-Labor Day week in almost 2 decades. So it's really kind of across the board.
And for you two, is it mostly your focus on New York City high end? Is that where you're training?
We do we love all our children the same, as my mother says.
Right. We're licensed in New Jersey and South Florida and other markets.
Long Island.
So, we have our tentacles in, all sorts of regions and price points across the country. But the same things that have been dogging the New York City real estate market have been dogging the rest of the country, which is low inventory and high interest rates. And both of those combined have been an absolute disaster for first-time buyers because it's really priced them out of the market.
And in terms of who's coming to you as clients, is there a specific demo? Is it mostly relatively young, middle-aged, Wall Street, foreigners? What are you seeing? Or all of the above?
It's really all of the above. I mean, life is such that people there are reasons to have to move. There are things that come up in life where you have to move, whether it's expected or unexpected. I mean, so it's pretty much across the board.
I was reading, Mickey, you two have been responsible, correct me if I'm wrong, for something like $3 billion in residential sales.
That's correct.
What do you think you two do different than competition? What's the edge?
What's the edge? We're not transactional. We make our clients our family, and it's about that's what it's about at the end of the day, doing the right thing by people and telling the truth.
Sometimes you have to tell your client who gets out on the sidewalk and says, "This is the perfect home for us." Like, let's keep walking. You're not buying it. Yeah. The building's bad. The financials are bad. It's haunted. You know, we break people's hearts, but they appreciate it, and we're not out to make the deal.
Let's say you have a property, Tom.
Yeah.
You want to market it. Where do you market it? Is it traditional media, social media?
I'm sorry I keep saying the answer is everything, but
that's
really,
a fine answer, Tom.
It really is all of that, because our job is to cast the widest net possible. We never know who exactly the buyer is going to be. We don't know exactly what the price is going to be. We certainly know within a range, and we don't know how quickly it's going to happen, but we certainly want to make sure that our listings are in front of each and every possible person who could be a buyer for that property.
Final question, Mickey. The NAR settlement, we talked a lot on this show, impacting compensation practices in the industry. That impact your business in any way?
It has not impacted our business. There are a lot of questions, and we're fielding those questions honestly with our clients. But we think it's been much ado about nothing, and in many ways the settlement has strengthened our business. We'll now have we'll have the ability to sign buyer representation agreements. Because it was like the Wild West before that. You could be working with somebody for 2 years and say, "Oh, I just bought something downtown. I met a broker." We're like, you can't do that with an exclusive listing on a property. But so it makes everything more transparent for the buyer, and I think that's great. And I think it gives sellers a lot of latitude too. That we've of course had some conversations with sellers who read the tea leaves wrong and said, "So I don't have to pay a buyer's commission?" Like, you don't have to, but you won't be seeing any buyers brokers. So there's a learning curve, but I think it's all positive.
All right. Tom, Mickey, great discussion. Thank you, guys.
Thank you so much.
Appreciate it.
Thank you.
And sticking with housing, U.S. housing starts data coming out today and climbing in August, the fastest pace since April. For more, we'll bring in Yahoo Finance's housing reporter, Danny Romero. Danny.
Josh, good news for the new home market. Government data out today shows that housing stocks rose more than 9% to an annual pace of 1.36 million units. That is the fastest pace since April. Now, the jump really came from construction in single-family homes, which was up 16%. There was also a really solid gain from building permits. That was up nearly 5% in August. Builders have been waiting for this turnaround in demand to pick up, to get the unsold inventory that has been hovering at the highest level since 2008. At the same time, mortgage rates have been moving down lower given the expectation for this Fed rate cut. The big question still remains is, will mortgage rates continue to move downward? And a message from Fed Chairman Jerome Powell today during his press conference, he said it's too hard to say where mortgage rates would really land, but if things work out to their forecast, other rates in the economy will move lower, but that all depends on how the economy evolves from here, Josh.
Danny, you also have a new story out on Yahoo Finance on REITs. Walk us through it.
Real estate stocks are really having a moment, and they could even extend their rally. I spoke with one portfolio manager who says that the market is really going to be in favor of a larger interest rate cut, which did happen. The Fed cut 50 basis points. So remember, real estate stocks were a bust this year, but that has completely turned around. Real estate stocks are up 17% this quarter. Bottom line, the portfolio manager says that the Fed signaling that it would lower rates twice this year is really an important factor to really sustain the rally in real estate stocks. Josh?
Danny, thank you so much. Stick around. More Ask for a Trend right on the other side.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement. Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetnista, your favorite financial educator. Welcome to Capital Gains World. For a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Companies have been racing to deploy generative AI into their work since the launch of ChatGPT in 2022. According to Microsoft and LinkedIn's 2024 Work Trends report, almost 4 in 5 business leaders believe their company needs to adopt the technology to stay competitive, and 3 out of 4 people already use it in their jobs. But adopting AI in the workplace also presents real risks, with many companies still trying to understand how to identify and measure them. Joining us now is Navrina Singh, Credo AI founder and CEO and White House AI advisor. Navrina, it is good to see you. Maybe to start, Navrina, walk us through, for our audience who may not be familiar, a little bit about Credo AI, your mission there, and also maybe your White House AI advisor role, Navrina. Walk us through the responsibilities there.
Well, Josh, so good to see you, and thank you so much for having me. So Credo AI is the leading provider of AI governance software, which basically means we help you with not only identifying AI risks, manage them at scale, and also making sure they're compliant to emerging regulations. Our software currently provides oversight of artificial intelligence among Global 2000 customers, including MasterCard, Booz Allen, Northrop Grumman, and many more. In addition, we partner with technology providers like Databricks, service providers like McKinsey. So what we essentially are providing is a tool, a software that can provide a standardized way for organizations to really manage their risk across their AI systems so that they can adopt artificial intelligence with confidence. And currently, I have the opportunity to serve on the National AI Advisory Commission, where my role is primarily to guide the government to think through what are the AI policies and bring AI expertise to policymakers.
And so on the role of sort of AI governance, Navrina, hot topic. I'm just curious how you think about the challenges of AI governance when, regulators should step in, whether they should step in and try to regulate what is a powerful and some obviously believe paradigm shifting technology.
Josh, you are so right. This is one of the most transformational tech we are living through and creating. Just recently, 56% of the Fortune 500 companies have identified AI as a risk factor on their most recent annual reports. And this is up, by almost 50% compared to 2022. And the reason that is happening is AI is becoming pervasive in whether it is in productivity tools for coding or whether it is being used in fraud models or in massively used, systems which could be promoting misinformation. So when you have systems which are so powerful, it becomes really important for enterprises, but also policymakers to think about how to put guardrails. And that's where this very interesting public-private sector interplay is coming, where AI experts like us work together with policymakers to make sure that we are thinking about the right frameworks to put oversight mechanisms in place.
Well, let's talk about a real-world example of AI governance. There in California, Navrina, Governor Newsom unsure about, it sounds like, signing that AI law, worried about the impact on AI innovation, but did, though, sign the anti-deepfake law. Walk me through your reaction, your response to what's going on there.
So one of the exciting things right now, and this is really we are seeing across the board, regulators and legislatures are taking a really strong stance in understanding this AI technology. And so what's happening in California right now is Governor Newsom is looking holistically across the use of artificial intelligence in different spaces. As an example, use of AI in political ads that could potentially promote deception for voters, which, as you can imagine, is a really critical time, or use of artificial intelligence, especially for musicians, entertainers, and promoting likeness. So there's been a recent set of bills that have been passed in California, but one that has been debated extensively is something called as SB 1047. And the reason it's been heavily debated is it truly is bringing a lot of focus on what does a good governance framework look like. And we can dive deeper into it, but highest level, enterprises that are building very powerful foundation models that potentially could impact massive misinformation concerns, cyber attacks. We need to start thinking about how do you put guardrails, and SB 1047 is an attempt to do that. And I think that's where we are seeing both sides of some really interesting debate happening as to should it be passed or not.
Navrina, sticking with politics, election, Trump, Harris, it's a toss-up right now. Somebody's going to win. What does that outcome potentially mean in terms of impacting, shaping future AI regulation?
Josh, AI is going to be one of the most critical points moving forward, irrespective of who comes to power. This is going to be a core agenda for all the legislatures across, by the way, the globe. So what this means is right now, whichever government comes into power is going to be important for us to think about putting in place the right regulatory frameworks as well as governance structures, not only to hold big tech accountable, but also to make sure that we are looking at, responsible use of this technology. And this is where Credo AI really comes in. We are making sure that standards like NIST, risk management framework, ISO, regulations like EU AI Act are easily available, not just to high-tech enterprises, but to startups and SMBs, so that they can continue to bring innovative AI technology to bear while making sure responsible use happens for humanity.
Final question, Navrina. We have a lot of investors listening to this right now. Why should they be pay attention to this topic of AI governance, Navrina?
AI governance truly is the need of the hour. If you, as an enterprise or as an investor, want to get the real ROI from your artificial intelligence investments, governance is the way to do so. We are seeing day in, day out, companies and enterprises using our software. They're able to build trust, as a result of which they are able to not only acquire new customers faster, they're able to retain customers, they're able to, most importantly, bring in innovative AI technology more faster to their organizations so that they can continue not only productivity gains, but also spin out many innovative technologies for their consumers. So this truly, AI governance is unlocking the potential of AI.
Navrina, thank you for joining the show. Appreciate it. Coming up, the iPhone 16 is set to drop on Friday, but our tech editor Dan Howley has got his hands on one. He's gonna give us a hands-on look at the newest details behind Apple's biggest product when asking for a trend returns. For our chart of the day, we're looking at CFOs and whether they think it's a good idea to take risks right now. Yahoo Finance's Shauna Smith joins me now with a closer look.
All right, Josh, let's take a look at this chart right here because this really illustrates, and spoiler alert, they actually don't think now is a great time to take risk. Actually, from this chart, you can see just 12% of CFOs that were surveyed by Deloitte in a most recent survey think that now is a great time to take risks. So this could be a bit concerning. Why is that? Because that means that they might be holding off on investments like M&A, other future growth opportunities, increasing their headcounts, things like that could translate into a slower economy, into slower growth. So that is why we're focusing on that. And compare that 12% to that level that we were not too long ago at the start of the year. You can see we started the year with CFOs about 40% saying that now is a good time to take risk. That has plummeted down to 12%. Some of the big concerns here for CFOs within the survey, one was the labor market, pretty similar to maybe some of the concerns that we heard questions to Powell not too long ago. They're concerned about the labor market, wages, ability to find and retain their top talent. And then beyond that, they talked about the fact that they were worried about risks as it pertains to geopolitics, and they're also worried about inflation. So all that to say, they're holding off, or at least now this would signal that they could be holding off on future investments. And compare that 12%, it's actually the lowest level that we've seen in quite some time. This chart goes back to 2017. 2017, so the lowest level that we've seen in just about 7 years. And I think the big question for investors at this point, or at least for business leaders, is how much worse it is going to get if in fact we are not, or the Fed is not able to orchestrate a soft landing. If in fact we do see any sort of recession, then we could expect that number to tick even lower there, Josh.
Thank you, Shauna. Apple's newest iPhone is set to drop this week, and here to give us a hands-on look at the newest features is Yahoo Finance's senior tech editor, Dan Howley.
That's right, Josh. We have the iPhone Pro, and we have the iPhone Plus. This is the 16, both of them 16s. Let me just walk you through some of the big features, right? So the main, I think, to do about these particular phones is the new camera button. You can kind of see it right where my thumb is here. There's one over here on the 16 Plus. Essentially what that's going to be able to do, and I'll show you on the Pro, is you'll be able to just press this button, fire up the camera, and then if you want, you can zoom in on different things. So you could do, for instance, let's say that's the Y. You can double tap and then bring up this menu here, slide through this menu. Let's see, we'll pick the zoom, and then you can slide, go back and forth through different zoom levels. The idea here is, sure, you can do that on the regular camera by going like this, but to do that, you have to get your hands on the screen. You also kind of throw yourself off of the subject. So this is supposed to be a way of being able to do that. It's also a way to sell phones because it's a different feature, and people tend to like that. There's a couple of cool things in that. There's some new kind of styles that they use in these photos. I think that's something that's going to appeal to a lot of people. My wife was actually playing around with it, and she had some great shots already. I've just been taking pictures of cats, and so you don't really get very stylized photos, except my cats are very photogenic, so I do. The other thing to talk about with these phones is they're coming with the new A18 chip. The regular iPhone Plus, 16 Plus and 16 have the A18. The Pros have the A18 Pro, and they basically say that because this is able to run more basically heavy-duty apps than the 16. It's not as though you're going to be able to not run apps on the 16 Pro or on the 16 that you would on the 16 Pro, but again, it's kind of an upsell. You're going to want to get the Pro because it sounds better and it's faster, so why wouldn't you get it and pay more for the Pro? One other thing that I want to point out for these new phones is the Pros are actually getting a larger screen. Instead of 6.1 inches, they're going to get 6.3 inches, and instead of 6.7, they're going to get 6.9. The bodies are a little bit bigger, but the way they really do that is kind of by cutting down on the size of the bezel. So you can see the bezel here on the 16 and bezel here on the 16 Pro. It's thinner on the Pro. Overall, I mean, look, if you have a 15 Pro or a 15 or a 14, it's not time to upgrade with these. The battery life, by the way, is great. I mean, you're going to go all day with these batteries. So if that's a problem for your current phone, go ahead and upgrade with these. The camera's fantastic, but that's kind of a given when it comes to the newest phones. I think if you're running, 15, 14, anything below that, these are a great upgrade.
Let me ask you a big selling point. The new AI features, right? Do you believe those features consumers are going to think, wow, shock and awe, gotta have that? Or is it more, is going to prove to be more incremental to the user experience? How do you think about it?
It's going to be more incremental. The thing about these phones right now is if you go to the store and you buy one, you're not getting Apple Intelligence right away. They're going to roll that out next month.
Right.
And then across next year, you're going to get them. So I think, out of the gate, there's going to be a few features that are good. There's going to be a better Siri. Basically, if you have any problems with your phone, you can say, hey, how do I do this? And Siri will literally show you a step-by-step bullet-pointed list of what you have to do to take care of that. That's going to be great. I was just helping my parents with something on their phones. Would have been awesome to have them just say, how do I do this? The other thing is Siri's going to be able to respond better when you interrupt it. So say, let me set an alarm, Siri, set an alarm for 25 minutes. It's going to pick up that you meant 25 minutes. The other kind of features are summarizing texts. So it'll be able to summarize text messages better. That is kind of hit or miss sometimes. I was using it with the beta earlier, but again, it's a beta, so we'll see what happens with the full release. And then the other is writing tools, where it basically can kind of gussy up your writing, make it sound more professional, make it sound more fun, and also summarize longer emails. So all of that's going to be coming, though, just not right now.
All right, Big Day Friday hits the store shelves.
Yep.
Dan, thank you. Appreciate it. That is a wrap on today's Ask for a Trend. Be sure to come back tomorrow, 4:30 p.m. Eastern, for all of the latest market-moving stories affecting your wallet. Have a great night.